What's up, guys? Eric here, Mr. Fired Up Wealth. I'm going to do a live stream here. Just bear with me as we kind of get started here. So I'm trying out some new stuff. I'm thinking about doing these live streams every Saturday morning. So let me know what you guys think in the comments. So on these live streams, there's two chat windows. There's a live chat window over to your right, and then there's comments for the video below. When this is done, you're going to have a recording. You'll be able to read all the old comments, and you'll also be able to read the comments below. So if this is helpful throughout the video, drop a like, drop a comment on that left-hand side. And of course, subscribe if you have not already done that. So looks like I've got a few people with me this morning. Derek, Matt, Anil, Polo. Nice to see you guys this morning. Happy weekend. I kind of want to go through some stock market news. I want to answer some questions. I did something like this. I guess Thursday or Friday. I don't even remember. I think Friday. It's been a whirlwind. I guess first, can you guys hear me and see me okay? The last live stream I did, the audio was a little bit echoey. If the audio is echoey, let me know and I'll fix it. Hopefully it's clear. Hopefully you guys are with me on the other side here. So I've got this other monitor on this side. I'm gonna be reading questions over here. The stock market was as volatile as I've seen it. I've been investing almost 25 years, and Friday was a really interesting day. It almost looked like a flush in the morning, but then it kind of retested a lot of those lows by the end of the day. And so it's like, you're asking me like, hey, what's going on, Eric? What's going on with the stock market? Are we going to be going higher? Are we going to be going lower? Okay, audio is good. Thanks, guys. And so, I want to do this live stream to give you guys a little bit of maybe comfort, but at the same time, I don't want to be the guy to tell you that everything's rosy and that the stock market's just going to bottom tomorrow and go to all-time highs. Because if you're new to the market, this is a really rough time. The seasoned veterans, the majority of those people are going to be very, very bearish with these conditions, and there's a lot more reasons to be bearish than bullish. So let's recap. A lot of you guys know this stuff. Some of you don't. What are the reasons for the stock market to be even going down in the first place? So for years, we've had quantitative easing, and basically, I won't go into the whole economic part of it. If you're interested in the economic side, I did something with Blue Suit Dylan on Twitter, and there's a Spaces that's about an hour long, and he presents a lot of that macroeconomics. And he does a very good job of it. And at the end, we have a Q&A. We talk about stocks we're buying, things like that. I'm going to keep this a little bit more high level just because it can get really boring if you just start talking about macroeconomics on a Saturday morning. But what you need to understand is that we have a combination of lots of things going on. The quantitative tightening is a big deal, but so are the interest rates, the inflation. Inflation is high, so the Fed tries to raise interest rates to lower inflation. And there's a million things under the hood from supply chain. We already had supply chain issues. We had, supply and demand. And now you've got issues like Russia, Ukraine. You've got China lockdowns. Just all this stuff is adding fuel on the fire. But when I look at the stock market and I look at what happened, last year, basically since the pandemic, 2020, tons of liquidity was pumped in the market, trillions of dollars of stimulus. A lot of us were locked inside of our house. We had nothing to do. People ran up stocks, especially speculative assets, trying to get rich quick. And so a lot of people want to compare it to like the 2000, the dot-com bubble. And there are some similarities in certain pockets, I would say, in the highly speculative pockets. But then there's arguments for the other side of it too, where not all stocks are created equal. But you have to understand that creates damage in the broader markets, and it pulls down their stocks. Stocks are heavily traded off algorithms, heavily traded in baskets, ETFs. And so, you look at like an ARK fund, there might be a handful of stocks that you think are higher quality than others. They're going to get dragged down every time ARK sells off because that whole basket's getting hit and so on. Same with S&P 500, with just technology indexes, cloud indexes, any kind of index you can think of. They all kind of trade in lockstep. So when cybersecurity stocks decide to sell off 15% on Friday morning, because of valuations, you've got the Zscalers, the CrowdStrikes, the Cloudflares, all of them kind of trade in lockstep and go down 15, 20%. Confluent, all of them. Snowflake was even down in the 150s, got down to 151 maybe. It didn't quite break 150. So, and I've been saying for months, like Snowflake could get down to that $150 level, and not to buy it, 200 and less was really the target, but never over 225. And some people were buying it, 350, 400. And so it's frustrating because if you're a new investor, you kind of get lured in, you buy the high, and now they want you to sell the low. You got that FOMO, fear of missing everything. So you're throwing money at stocks and it goes higher and higher and higher. And now the stocks are going lower and you've got that fear of losing everything or full. And so it can be really tricky. And now, just for comparison's sake, I started investing in the late 1990s and I went through something like this before. It doesn't mean that we have to have the same exact period where it takes years to get out of it, but we have very similar sell-offs in some of these speculative and growth type names. And so I totally understand. And you want to blame somebody, like I'm going to blame Wall Street, I'm going to blame the suits, I'm going to, blame whomever. But the thing about it, guys, if you have quality companies, these quality companies are going to do great things with time, and they are going to be worth more, and they are going to have total addressable market they're going to grow into, and they're going to grow into those valuations. Now, if you've got stocks that, have no path of profitability, no free cash flow, that are trading at ridiculous valuations, some of the meme stocks and stuff like that, I mean, you have to be careful because there's no guarantee that those stocks have to go back to their all-time highs, and there's no guarantee that some of these companies won't go out of business. And that goes for any kind of speculative asset, from stocks to even some of the altcoins that are more speculative when you think of cryptocurrencies and so on. So what I've always taught, since I started this channel in 2019, well before the pandemic, is a balanced approach. A balanced portfolio with ETFs, with dividend stocks, with growth stocks, managing spec, always having cash. Top 15 investing rules. Go to Twitter. You can find my top 15 investing rules. But number one rule is don't invest money that you can't afford to lose. There's rules in there like no FOMO, so no fear of missing everything. Missing out. Don't chase something just because it's going to the moon. And it's tough because you get lured in and you don't know how to maybe value a stock. And trust me, I've got reds too, guys. So I'm not perfect, and I certainly made mistakes last year. So I'm not trying to be like I'm perfect and everybody else isn't. But even the stuff that I bought, like if I think of a Unity, I wasn't buying it at the highs, and I certainly, don't have the best cost basis in the world, but it's still under $100. Like you look at Upstart, it got to $400. Wasn't buying it at $300 and $400, but certainly thought it was a buy at 150 and less, and was buying it, and then got down to 75. So a lot of these stocks just got hit way harder than you would ever expect. They go lower than you would predict. And it can be really tough because now you're looking at a portfolio going, I'm down 30, 40% or whatever you're down. I mean, I'm down about 30%, and I have a pretty balanced portfolio. I own stuff like Costco, Home Depot, AbbVie is one of my largest holdings. And it's funny because you look, my largest holdings for the longest time were Nvidia and Amazon and then QQQ. And now it's QQQ, Microsoft. There's been a whole shift. Anything that had high PE or no PE with price to sales, the market's trying to revalue those. So if I look at things like cloud stocks, for example, if I look at cloud stocks and I say, why are they selling off so hard? If you look at the mean and what those things cost, they got way ahead of themselves and got elevated up. Now they're basically back to the mean, the median about a few percent higher basically than that. And if you look at a lot of charts, we'll look at some charts here in a second. Like the QQQ, for example. This light blue line right here, this goes back to basically October 2020. So if you recall, so here's the pandemic. I'm going to go all the way over here so you can see this. So the pandemic low was 164.93. And I actually got some QQQ at 164.97, complete luck. I looked at a chart and I'm like, and I always buy with sevens. So I always buy like 97, 37. I always enter the 7 because I'm superstitious. I'm weird like that. But it got down. So if you look at this, if you just forget about what happened after the pandemic and you look at, it basically was running, had this dip in 2018. Now this dip right here, guys, it's not even a dip. It's a nice little correction to a crash type, market we had. This was 2018, and this was when President Trump was the president, and Jerome Powell was still the Fed chair. And we started same kind of process we're doing now, raising interest rates, not being as accommodative, more quantitative tightening than easing. And this is what happened to the market, and it looks like a blip on the radar now because it's way up here. So like anything you bought back here, you're way up. The problem is if you're a new investor, you bought way on the other side and now you're upset, you're pissed off, right? So two things I want you to focus on. Number one, this is what happened last time and we're experiencing the same thing. The pivot here is when Powell basically said, okay, we're not going to do 3 rate hikes in 2019. We're only going to do 2. And then some of the tensions from the China, trade war with Trump and China started to subside a little bit. We had some positive news and the market ran really, really hard. So what you need to understand is that the market was running hot going into the pandemic. It was at all-time highs. The QQQ was at $237. It dropped down to $165 basically. And then it was just a straight line. And if you look at this chart now in hindsight, this is pretty parabolic, $164 to $400. That is a very parabolic move and there's lots of profits to be taken. And so the selling just gets worse and worse and accelerates. The problem is if you came in the market and you started buying up here, you're in a lot of pain. Now, the good news is if you just started, you probably have lots of time on your side. And if you really zoom out the lens, I've showed this chart before. This was the dot-com bubble back here. Let me see if I can get this. So this is the beginning of QQQ, started in the late 1990s. Went to $120. It dropped to 19. I'm not saying that this is going to happen this time. I'm not doing that. What I'm showing you is this big circle here. This was accumulation phase. So a lot of people that bought the top, they all got out of the market, including most of my friends, and said, screw this noise, Wall Street's rigged. And they never came back in the market. I was buying this whole time and it was frustrating because the market was just kind of slowly grinding higher. And it was like, it wasn't really doing much. And then we started more quantitative easing, started pumping liquidity in the markets and boom, here's what happens. The economy starts to expand and, now you've got this big runway. So this is where people like economists and things will look at charts and say, this thing could correct 50%, blah, 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 blah. And it's not to scare you. It's just to show you history so you know where we've came from and what other talking heads are talking about. So you have some insight. Now, what I want you to focus on here, a couple of different things. This purple line is a trend line, and I'm not including the sell-off here. Now, something else to talk about here. So this right here was the pandemic drop of the QQQ. It went from 237 to 165. What happened is basically the federal government came out, started pumping stimulus and started buying back, doing quantitative easing, the Fed, and it stimulated the market and put money into investors' hands. They were all locked up at home and they started putting money into speculative assets, anything that they thought they could get rich overnight on, from cryptocurrencies to growth stocks, hyper growth stocks, meme stocks, whatever it was. And there was no due diligence on this is why I'm buying this stock. It's just I'm buying this stock because it's going to go higher, diamond hands, YOLO. And you knew that was going to end poorly. And I had said that to the group for a while that some of that spec, those bubbles are going to end poorly. But unfortunately, it brings down everything with it, including quality, which I don't deny that, say, SaaS stocks were ahead of themselves. Now, I had this conversation with a VIP this morning, and he was like, these could still go lower. And the answer is yes. Now, if you look at the cloud stocks I own, I bought them way before the pandemic even happened. So if I look at Datadog, if I look at CrowdStrike, if I look at Cloudflare, they were pretty much all 2019 IPOs and was buying them back before we had this whole thing happen. And so I've got great cost basis on those stocks. Zscaler was a 2019, and a lot of those stocks I covered on this channel right here, well before that they were hyped everywhere, on Twitter and all over the place. Now everybody wants in on those names because that's where the growth's at. We've been talking about those names for a long time. I've owned those names for a long time. The ones I got hurt on were the ones that were new IPOs. So anything that's a new IPO, that's a new SPAC, that's a direct listing, what you have to understand, and it's easy in hindsight now to see it, those type of stocks that came to the market public in 2020 and 2021 was in a time of rabid euphoria. And those prices were jacked to the moon before we even got to touch them as retail. And so what happens is you got venture capital that was already way too expensive. It gets to an IPO phase, and the big banks, institutions, they pump it up even more, right? And everybody gets their piece of the pie. Like Warren Buffett even was invested in like Snowflake way before we could touch it. Everybody's getting their hands in the pot. So the big fish get bigger, the wealthy get wealthier, the rich get richer. And this is where people get frustrated and say, well, screw the 1% and eat the rich, and the rich get richer, and it's this wealth gap. And there's some truth to that. The way that you can beat it is by investing long term. There is no get rich quick. I came from literally a single family home. My mom made like $10,000 a year working at a gas station. And Mom, I love you to death. You're awesome. But we didn't have a lot growing up. I had everything I have. I had to work hard for it. And sure, I had opportunities. So I'm not ignorant to that. I have opportunities because of where I'm born, what I look like, all that. But I can't change that. I can't change where I was born and who I am. All I can do is use the opportunities presented to me to do the best I can with what I have to work with. Everybody gets a hand of cards. And my hand of cards was work as hard as you can, put as much as you can in the stock market. It was $50 a month at first, and it became more and more and more. And I've been investing literally for the last 20 plus years, just chipping away, trying to gain wealth. And I've been through massive upturns, massive downturns, and I just keep buying the whole way through. I tried to shave some last year in November. I thought maybe we'd have a little bit more of a run up in January and February, trim more. Didn't happen. Fed came out, was very hawkish, essentially saying, hey, we're going to raise rates. We're going to do quantitative tightening. The market fell down. And a lot of this comes down to trying to control inflation. And I think the Fed, in a way, wanted the market to cool off because there's a thing called the wealth effect, where if you've got your 401k has millions of dollars, now you go spend a bunch of money, and that's going to increase inflation because supply and demand. More people have money, more people they throw around. So you need to decrease that demand, and you can do that by taking some money out of the pot. And you can do that by what's called the reverse wealth effect, where you take somebody that has a $1 million portfolio in their 401k, and now all of a sudden it's 600 or 700k. Now you're like, oh my God, I'm not a millionaire anymore. I'm not going to go on that $5,000 vacation. I'm not going to buy the more expensive car. I'm not going to go buy the Starbucks coffee before I go to work. I'm not going to do this or that. And so the problem is then it can cause something that we don't want, which is a recession. And a recession is just 2 quarters basically of suppressed GDP. We've already had one of those. And now we're going into possibly another one where we might see it again. So we might be in this mini recession. It doesn't have to be the dirty 30s where it's like 10 years of doom and gloom, but we're going through a contraction period. So you've got asset prices that are really expensive. Even the S&P 500 historic PE, the Shiller PE, all those are really high. And that's going to have to come down. It's going to be a combination of the market coming down, which it has, and it can certainly go a little bit lower. And it's going to take time, and we're going to need catalysts. So if Russia decides to end war with Ukraine, catalyst, market goes higher. If all of a sudden the CPI data, that's inflation data, we get that on May 11th, that comes in late, maybe the market goes higher. But we don't have really any catalysts. Biden's trying to pass something right now for semiconductors. It's a $50 billion plus deal that includes semiconductors. That gets passed, semiconductors get a boost. Semiconductors are cyclical. They lead the economy. They lead the markets, generally both directions, up and down. If you look at semiconductors, they started falling before the rest of the market. The rest of the market came right behind it. I told the Patreon Discord that that's exactly what was going to happen, and that's what happened. Make sure you guys like this video if you're getting something out of it. Make sure you subscribe if you're not subscribed to the channel. I really do appreciate you guys watching. I'm going to do some questions here. So if you have questions, make sure you post them on the chat, and I'll get to those here in a second. I think I'll stop there because I can talk all day, but I know this stuff really well. I know the markets really well. I've been doing this for over 20 years. Not that it matters. I'm not smarter than anybody else necessarily, but my undergrad is in international business, focus on financing economics, and I have a master's degree in business administration. I worked in real estate for about a decade. I worked in software sales, basically on-prem to SaaS, that whole journey. So I understand the whole software as a service environment as well as the hybrid environment. And I've been doing this full time, believe it or not, since the end of 2020. And sometimes I question my life decisions because I think I made $460 on YouTube last month in ads. Thanks for anybody that's a patron. And if you want to join the private community and you want to help support what I'm doing here and trying to educate as many people as I can, join the Patreon, because that's really what makes this happen. The only reason I can do YouTube is because of those people that help support me. So if you're watching and you are a patron, I appreciate you. If you're not, check out Patreon Fired Up Wealth and join us in there. We've got a Discord community where we've got private channels that are hidden unless you upgrade to Elite, and we talk about this stuff all the time and we help each other. And it really is a sense of calm during the storms to try to think long term. Like, this is a crappy situation, but if I have a target of 2030, I'm not really sweating it that much. It sucks because I lost 30% of my portfolio, but now I have an opportunity to buy. And I teach discipline to always have cash. I teach discipline to have diversified portfolios. And if you were following that, if you did the masterclass, if you're in platinum and did the masterclass, I've got a 11 and a half hour class, 12 different classes that are about 45 to 60 minutes each, that goes from investing from A to Z, talking about stuff just like this, but helping you become a better investor so you can make your own independent decisions. That's what I'm trying to accomplish here, and I'm trying to just help as many people as I can on YouTube and anywhere I can. So check out that stuff, guys. I'm going to go over to questions here. Before I do that, I lost my train of thought. Purple. So this trend line, if you look at it, the algo's kind of held up the QQQ right on this trend line around $305.10. And I've been telling the group for literally since March, maybe even February, that 305 was a possibility. It held that S1 for now. This is possible 305. This is old, and that's what happened. It bounced off 305.10. Exactly what I've been telling the group. We do chart day every Wednesday in Patreon Discord if you're in a lead or above, and we go through charts like this, and I explain what's going on and give you my opinions. And I'm not a financial advisor, so I want you to make sure you understand that. I'm not a fiduciary. I'm not a financial advisor. I can't give you financial advice. I can only give you information. I can give you opinions, and you got to be your own independent investor and go out and make your own decisions. And that's really what I'm trying to do. I'm trying to educate so that you can be a better investor and make your own decisions. I'm not trying to tell you what stocks to buy, when, and what to sell, and what's best for you. I'm showing you all the possibilities so you can make an informed decision that's best for you, for your suitability, your risk tolerance, your age, your goals, all those different things. Whoo! There you go, man. That's about as good as I can do on a live stream without any editing or anything like that. So I don't know why this channel doesn't have more subscribers, but it'll get there. I'm just going to keep plugging away. I mean, there's how many YouTubers out there really have the depth and knowledge of the markets? Anybody can regurgitate an article from Seeking Alpha about top stocks to buy, but do they understand the markets and all this stuff? I'd be willing to bet there's only a handful of us on YouTube that really understand it. And the ones that really understand it probably aren't doing videos on YouTube. I'm only doing this because I feel like it's my calling to try to help people, because I came from nothing. And my mom used to tell me the stock market was rigged and that I couldn't beat it. And the reality is you probably can't. The only way you can beat it is by investing long-term, and having a combination of quality and ETFs. Because if you believe in the American economy is going to expand over time. It's going to have ups and downs. But if you have the right time horizons, this is the easiest, the best, the simplest, most productive wealth creation tool on the planet. And that's what stocks are. They're tools, they're instruments to generate wealth and nothing more. There should be no emotion tied to it. You're not married to it. None of this, top stocks to buy now and hold forever. That's BS. You don't hold anything forever. If the story changes, you sell it. Now, I'm not just dumping my stocks right now because the stock price is down either. The story has to change. If my time horizon is 2030, sure, I shaved some Cloudflare when it got to $190, and now it's house shares. And it sucks that it went from $220 to $60, but my cost basis is literally zero. So you know what I mean? Like if you're smart about how you're doing this stuff, you can put yourself in a better position so that you have a much better chance to outperform the market and quote unquote beat Wall Street, or beat the suits or whatever you want to call it. So let's go through some of this stuff, guys. Audio is good. Thank you for letting me know on that. Stay calm, we'll be fine. Always keep liquid funds. That's good advice, Shane. Do you think thematic sector ETFs underperform the VTI VU over the long term? Kevin, the thing about thematic ETFs is that they're going to be, it depends on the ETF, of course, but generally when you think of thematic ETFs, and I think where you're going with that is like technology-based ETFs, but thematic ETFs can be anything. It can even be sector ETFs, like I'm going to invest in real estate or invest in this. thematic is usually like a theme like metaverse ETFs, or so it's going to depend on the ETF and as well as the management team that's buying and selling assets for that that traded fund, that ETF. But for me, if I look at like a WCLD at these rates, I mean, again, I'm not a financial advisor, and these certainly can go lower. But I'm a fan of cloud, and there's here's the thing with ETFs: there's good stocks and there's always going to be bad stocks. It's a basket of stocks, and you can pick the best. But I mean, this thing started in September of 2019, and it was way before we had any of this stuff going on. And it's back to basically $30. And I could argue that 3 years of cloud expansion and growth, probably should be worth more than $5 a share on the WCLD, and it might be overdone. And that when the market does find its footing, that this is probably going to go, a little bit higher. I'm not saying it's going to go to $65, and I'm not saying it can't go lower. Maybe it tests all the way down to $25. That could happen. But if I'm buying anywhere in here, and here's the thing that people get, like the mind game, investing is so much psychology and discipline. It's really a head game. So you want to be able to like time the bottom, and like a lot of people want to time the bottom perfectly, buy it at the bottom, and then have it go up every day from there. And obviously, if you're a trader, that's what you're trying to do. You're trying to time the market and trying to make profit. If you're an investor, you got to understand you're playing a different game than a trader. And this is where people get confused, because you go on Twitter, you go on social media, it's a mix of people that are, that are trading, that are swing trading, day trading, investing. Some have agendas, some don't, and you don't know really what to believe or what to trust, and it's just confusing, especially if you're new. There's just information overload, and it can really screw you up. But if I'm looking at this and I want to buy it, I'm probably buying some here, and I know it can go lower, and I'm just buying it. And people get discouraged because they buy this first yellow circle, and then it goes lower, and they're like, "Oh, I should have waited. Oh, shoulda, coulda, woulda." Don't do that. Here's the thing: you're going to look at it and say, "I'm going to hold it for 10 years." At least I wasn't buying it, at 43. And again, you have to do the research. If you think it's going to go to $20 or you don't believe in anything that's in the ETF, of course, by no means buy it. But if you believe in what's in that basket, you're probably nibbling in this area, doing your best you can, knowing you can't time the bottom. You're probably going to be red on it. But when the market snaps, it's going to give you a great compound annual growth rate, and you're going to get nice returns off it. It's probably going to beat the market. So when you ask the question, do I think VTI will underperform over the long run, you got to remember too, the reason that the VU has performed as well as it has, and really even the total index fund, technology is what's really made this work. And of course, valuations are high. But then I look at Microsoft and Google, and even Amazon's getting much more attractive as it gets closer to $2,000 a share. I mean, Apple's expensive, but I look at Google. Google's like a 20 PE ratio. I posted this on Twitter a couple days ago or last night. Clorox is a 42 PE ratio, I think. Costco is a 40 PE ratio, and then you've got Netflix at like a 16. And I'm not saying you should run out and buy Netflix, but is Netflix really that bad that it should be trading, at a discount to the overall S&P 500? I don't know. I mean, you tell me. Maybe Netflix is going out of business. I don't know, but I don't own Netflix. I just think some of these valuations, everybody's so afraid of growth, they pile into all these value stocks and these dividend stocks. There's nothing wrong with them, but I mean, don't go buy Clorox at 42 just because it's a safety stock. Yeah, it's going to pay a couple % dividend, but that stock is going to end up going down when the money rotates out of it, and you're going to be bag holding a stock that has zero growth and that can't grow into itself. The nice thing about a hyper growth stock is that even if you're bag holding, these things can grow so fast that if you've got the right time horizon. I made this comparison last night in Discord to the elite community. Let's say I'll use Cloudflare as a good example. Let's say you got into Cloudflare at $100. Okay, we bought Cloudflare at 35 and 40. I know you're tired of me telling this, but it's a good example and it's a lesson. But a lot of people were chasing at 100, 150, $200, whatever. It got to 210. It ran from $30. I'll show you a chart. It ran from $30 to, so we were buying Cloudflare back, let's see, Cloudflare, September. So we started buying it right here. This level between, it got like, 42, and then I remember it went down to like 32, and people were like freaking out. Oh my God, I bought it at 42 and it went to 32. And I'm like, it's all good. I'm just buying more, whatever. And I had some back here like at 20. And then, it shot up. So it literally ran, guys. I mean, this is a parabolic move, like a lot of these charts. So from $30 all the way to $221. You don't want to be buying this top up here, right? But let's just say that you were a little bit more disciplined, and this is what happened to me on a lot of these stocks. Okay, so I wasn't buying up here, but I was like, waiting. And Cloudflare is not one that I bought. I bought it back here and I didn't buy. But let's just say that I didn't have it, and I decided to get in at say $100. So we're going to draw this purple line here. Let's say I got in at like $100, and you're thinking, I just got a steal of a lifetime. It was a $221 stock. This thing's going to go back to 200. I'm going to make 100% return. That's what you're thinking. And a lot of times people look at the historic stock price and assume it's going to go back there. Be careful of that because there's no guarantee, or it could take a long time. It could take years to get back there. Upstart ran, same kind of thing, ran from like $30 to $400, and who knows how long it'll take before it gets back to $400. Sometimes never, but I think that one will with some time. So say I bought Cloudflare at this purple line, and then now it's trading at $69. Okay. So you're down 30% on this stock, and you did your best because you were disciplined and you waited till you're like, it'll hold $100 because that's a good psychological, and there's no way it's going to retrace this whole thing all the way back to October 2020. Well, the reality is a lot of these growth stocks actually are doing exactly that. If you look at the charts, they're literally shaving off and going. We had this rally here at the end, like fall of 2020, and we're kind of going back to the beginning, the bottom of that. You see this purple line here? This is where it's priced at right now, around $70. And this line's not perfect, but it's literally going back to, this is October 2020, and that's what a lot of them are doing. But let's just say that it was $200, and you're like, $100 is a steal. I'm going to buy it. I got it for $99.99. I'm happy, right? And then it goes lower and lower and lower. And say you didn't dollar cost average, you bought it all at once, which I don't recommend. That's why I recommend dollar cost averaging. Because if you would have bought some at 100, you could have bought some at, at 90, at 80, at 70. You'd have a $85 cost basis, or whatever that math is, and it sucks, but you're not that far off from where you need to be. But let's just say you bought the whole thing at $100 because you didn't learn, dollar cost averaging yet, and now it's at 70. You're down 30%, and you think, oh my God, I'm going to panic sell. Well, here's the thing. Even if it took a year, which I'm not saying it will, but even if it took a year just to get back to $100 a share, let's say it took a year, and then let's just say it takes, let's say it takes 4 years to get back to not even 221, but just to get back to $200. So this is a $200 line here, right? Let's see if I can draw this for you. Hopefully these visuals help. So so this line is $200. So you bought it $100. Okay. So here's where you bought, you buy, and you didn't dollar cost average. So you buy here, right? All right. And now the current price is down here. So the current price, right? All right. And it takes 4 years to get back to $200. 4 years, $200. And let's just say that you have a 5 or 10 year horizon. It could be worth a lot more than that. This is just illustrative, and there's no guarantee. I'm not saying that I'm guaranteeing that Cloudflare will be $200 in 4 years, but I'm just saying, let's just make the assumption for fun. So you bought it at $100, it dropped to 70, you're down 30%, okay? If it's $200 in 4 years, you paid $100, you still made 100%. That's 25% return basically over 4 years. Now, generally speaking, the S&P 500, will give you maybe 10% with dividends reinvested historically. So you probably end up outpacing. This is just an illustration for fun, the demonstration. So let's just say that 10%. Let's say the S&P is 10%, and you can make arguments that these type of stocks won't do well for a long time. The S&P's might perform. I get all that. I'm just humor me for a second. You don't have to agree with the damn word I'm saying. I'm trying to give perspective to some people, especially young investors, of what the possibilities could be. Let's say the S&P 500 gives me 10% a year. And it's going to have a little bit of a snapback because it's down 12%. So, let's say even let's just say it gives me 12% a year from the bottom, like from these same prices. if you do the math on that, even, we'll use 10% because it's easier math, and I'm not that smart this morning. So S&P is 10%. You're going to get 100% in 4 years. S&P 500, you're going to get 40%. Okay. So is there a lot of pain right now when you're down 30, 40, 50% of these stocks? Yeah. Is there a guarantee it goes back to $200 in 4 years? No. But if it did, just to give you an illustration, 4 years is a long time. If this company keeps growing at the clip it's growing, it could grow. It could easily be $200 in 4 years. It could be higher than that. You can make an argument it could be less. It wouldn't even have to be $200 to outperform the S&P 500. You get my point? If the S&P 500 is giving me 40% and this gave me 100%, return. So S&P 500, 10% return times 4 years equals 40%. You get the math, right? You got 100% return on this one, divide it by 4, it's 25% a year. So you're still like doubling the S&P 500 returns. But it's hard for the brain to think that way right now. You're just thinking, here's what you're thinking. You're thinking, oh my God, I'm an idiot. I should have bought it here instead of here. Poor me. I'm going to lose everything. It's going to go to zero. It's going to go to negative $8. So, and that's what your brain's thinking. Well, Cloudflare, a lot of these companies, when you think of Datadog, for example, $1.6 billion cash on books. I think Snowflake has like $3 billion in cash and cash equivalents. Most of these companies are sitting on, $1 billion or more in cash. And so even if they have a cash burn, like you think of HashiCorp has cash burn, but it's sitting on so much cash that it doesn't really concern me as much. But the market doesn't care. The market right now, the playbook is if it's burning cash, it doesn't have free cash flow, path profitability, doesn't have earnings, doesn't have a P ratio, it's out of fashion. And I get it. I totally get it. And I get that high interest rates and quantitative tightening will impact those stocks, and it'll hold their performance down. So maybe it's possible that these stocks don't recover in 4 or 5 years. But here's the thing. If I look at Clorox, or if I look at one of these hyper growth stocks and I look at Clorox at 40 PE, for me personally, I think I have a much better risk reward buying, even though this is still crazy expensive. If I could get it lower, I'd love to see Cloudflare at like $50. So that's where I'd be like, hey, $50. I could always go lower, but I think $50 is a great. I'm not saying it's going to go to 50. I'm just saying if I got, Cloudflare at $50, I'd feel okay about that. I bought it back here at 35 and maybe it gets to there. Who knows? But my point is Cloudflare dollar cost averaging between $50 and $70 versus buying Clorox at a 42 P ratio. I would rather put my money in Cloudflare, but it depends on you, your risk tolerance, your age of suitability. And there's things that we talk about in the Fired Up Wealth community. You have 2 phases. You have an accumulation phase and you have a preservation phase. If you're young and you don't have a lot of wealth, you're trying to accumulate wealth. So you're working hard, you're saving money, you're trying to invest. If you're trying to outpace the market, you're probably taking some additional risks. Now you have to be careful with those risks, because those risks, it's easy to say that you have a high risk tolerance when the market goes up every day, but now you're finding out, you're getting a gut check. Maybe my risk tolerance wasn't as risky as I thought it was, because you're not feeling great. You're not sleeping well at night because of how much your portfolio is down. Once you get those millions of dollars, then you need capital preservation. So you got to remember, the majority of the money in the markets are people that have a lot of money and they're trying to preserve capital, including institutional investors and institutional funds. Their job is, number one, is capital preservation for their wealthy clients, and they're going to get compensated based on performance on an annual return. So they're not thinking about 2030, they're thinking about right now. And right now it's kind of a shitstorm. We've got a lot of negative catalysts. So if I'm a money manager, I'm selling stuff back earlier this year in cash. I'm buying oil stocks, I'm chasing those trends, and I'm trying to make profits for my customer. Now, if I have a 10-year horizon and I'm a growth stock tech investor and I believe in innovation, that we're in this innovation 4.0 stage, there's good stocks and bad stocks that fit in that category. But there's going to be a lot of money to be made. Just like when I was buying FANG stocks, 10 years ago, when everybody said that those were crazy expensive. Well, now everybody wants to buy them. Some of these stocks could be that. And we know that we're not going to be right every time. Peter Lynch, of course, is not a hyper growth investor. He's a value investor. But he said if he was right 6 out of 10 times, he's doing pretty well and he's beating the market. And he crushed the market for years at the Magellan Fund with Fidelity. And he owned a bunch of stocks and hedged his risk that way. And I try to follow the same approach. I've trimmed some stocks. I used to have more, and now I'm sitting on 75 positions. My retirement is generally ETFs. So anyway, your time horizon matters and your goals and what you're trying to invest in. If you believe in Tesla and the future of Tesla, it's expensive at 111p ratio, but that, your DNA, your portfolio should be an extension of your DNA too. You shouldn't just go buy a boring consumer staple because everybody else is for a year. And money, you got to remember, money goes in cycles. What's in trend today and fashionable doesn't necessarily mean it will be next year. The majority of money flowing in and out of Wall Street is thinking short term. And right now, there's more negative than positive in the short term. If I zoom the lens out and look 5 to 10 years, I feel really optimistic and I feel very great about the future. And I'm confident and have conviction in what I own that it's going to be worth a lot more money when I need the money. So right now, I'm trying to grow my portfolio to something $4 or $5 million, try to get to $150,000 to $200,000 in passive income. And that's going to be my capital preservation passive income phase in 2030. So again, subscribe to the channel if you haven't, because this is the journey you can follow and you can help support basically, by joining this. So this is what I do full time. And I work as a contractor for the Motley Fool. So I do articles for them. I've got Patreon Discord. I'm on Twitter. I'm on TikTok. I just started Snapchat last night. So now I'm on Snap. I'm feeling old at my age here in my early 40s, but I'm really just here trying to help you guys out. So you ask me a question, I give you a 10-minute, 20-minute response and go on a tangent, but hopefully this stuff's helpful, guys. I'm milking cash flow from call credit spreads on Shopify. My long-term dividend portfolio is down heavy. Yeah, I'm down over 30%. I think anybody in growth is probably down that. I mean, the NASDAQ, the QQQ is down 22%, 23%. So if you've got any beta additional to that, you're probably down a little bit more. And I even have like almost 40% of my portfolio, I think, is in dividend stocks. But I've got a couple bank stocks, and so I've got like JPM and Bank of America. I've got Home Depot, but all those are crushed too. I was going to talk about housing market. That's a whole nother. I could go off for 2 hours on housing. Maybe we'll do that next Saturday. So my idea right now, guys, is I'm doing videos on YouTube Tuesdays and Thursdays. So here's my schedule if anybody's interested. Every Monday morning, I do a live stream podcast. It's an audio podcast like we're doing right now. I often do real talk like we're doing right now. I do it every Monday at 9 o'clock a.m. Eastern. That's 30 minutes before Wall Street opens. And I do that in Patreon Discord. If you're an elite or platinum, you have access to that. And those are recorded. They're audio podcasts and they're posted on Patreon. So that's Monday. I do one of those every Monday. Tuesday, I'm trying to do a YouTube video every Tuesday afternoon. Wednesday is chart day in Patreon Discord. We go through charts like this. People give me tickers from the group and I go through and look at charts for them. Thursday, YouTube video. Friday, another real talk / stock market news podcast that's in Patreon Discord. And I'm thinking about adding Saturday mornings like we're doing right now to do market recaps, especially right now during the volatility, just to kind of recap what's going on and hopefully provide some comfort for the long-term investors, because there's just not a lot of people out there talking about, past six weeks and 6 months. So don't get me wrong. If you just joined, this will be available as a recording. Go back and watch the whole damn thing. And if this is helpful, drop me a like and drop me a comment on the left-hand side. But honestly, guys, I'm not trying to tell you that the market is fine, everything's rosy, but I'm also not trying to scare you, because if you got the right time horizon, you don't need to necessarily lose sleep at night. And we could bottom any time with any sort of positive catalyst, or even just the technicals might decide, the algos might decide it's time to start buying. And you have to be really careful though of this. What I will say, we had a little bit of a bounce in March and people were like, should I chase these stocks? And I remember specifically like Cloudflare, $110 or something. And I'm like, if it were me, I would be patient, because, this could be a fake out and you might get more opportunity later. There's a lot of, bad news storming and we could, see more. And I was still buying, but I was telling people, don't go crazy. I turned my buys to very small nibbles. And you saw it in Discord. I share all my buys and sells in Discord. There's actually two different portfolios I share. My main taxable brokerage, which is about $1.25 million now. It's down 30% year to date. And then I've got a bunch of other accounts as well. And I have another taxable brokerage. And I also have, several retirement accounts and blah, 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 and some businesses and whatever. But the main thing I talk about is that $1 million stock portfolio, which has growth stocks that we're talking about today, kind of mixed into there with dividend stocks. And then I have a new portfolio, and there's a whole series in the channel. It's called, if you go to the main homepage of Fired Up Wealth, there's playlists, and one of the playlists is how to build a portfolio from scratch. We started a new portfolio a couple months ago with $5,000, and I've been dollar cost averaging into that. And it has a combination of ETFs, dividends, and growth stocks. Just added Toast under 15, which I think is still pretty expensive, but it trades at a 4 EV/NTM, 4 price to sales. The margins are low on that one. It's like 20%. So I think it could go a little bit lower. It's a star position. It's a small position. What's cool about that smaller portfolio is if you're a new investor, it makes more sense to you, because it's like if I were 25 or 35, even if I was starting a portfolio, that's what I'd be buying right now. The stuff I'm buying in my top portfolio, I've already got Microsoft's, Google's, Amazon's, Nvidia's, like all those I've had for a number of years. They're up, nicely, 500% still on a lot of these names. And I'm not adding to those, but if I were starting a new portfolio right now, I might be buying some Google. I might be nibbling some Amazon. I might be, looking at Microsoft. I mean, I would want some of that mega cap tech mixed in there. I call it tier 1 quality. I think AMD is a good opportunity here. I think, Airbnb, especially lower levels, could be a good opportunity. There's some risk there with, it's a reopen play, but then if there's a recession, people might not go out as much. There's kind of that double-edged sword there. And I shared a bunch of these in Discord. So if you're interested in more, I've got a watch list channel, and I spent an hour last night going through, here's all the stocks I'm buying. Here's the ones that are highest priority. Here's the ones that are kind of second tier priority. Here are the stocks to avoid. Anything that's, B2C, anything e-commerce. I have a whole list of stocks to avoid, and I have some commentary on some different stocks in there, like HCP and a few others. So let's keep going here. So at least you can sell covered calls. The problem about covered calls right now, Michael, is that the premiums are really terrible. I looked last 2 days at covered calls. When the market's going down, the premiums are really bad. Even if I go out and do leaps that 2 years out, they're not really that good. So that kind of sucks. And I don't want to go do a cash covered call on a price that I'm not really that comfortable selling at. You know what I mean? And the sentiment's so bad that most of these cash covered calls just aren't really helping me out that much. The cash covered calls in 2021 were absolutely ridiculous. I remember I bought Fastly at like 20, and I sold at like 110, but along the way I kept 100 house shares, and I was selling cash covered calls. And I remember getting like on 100 shares, I was getting like $3,000 and $4,000 premiums with a $190 strike price with like a 6-month expiration. I mean, that is just I've never seen anything like that. I was doing like Salesforce cash covered calls at $250 strike price, Snowflake at like $450. And it's like, hey man, if that goes to those prices, good quality, high quality problem to have. Even SoFi, I've got $35 cash covered calls on SoFi. The thing's trading at $6. That just goes to show you how euphoric the market was, just how frothy we really got, especially November of 2021. And I remember every day, like my portfolio was all-time highs, and it just felt surreal. And I was shaving a little bit. In hindsight's always 2020. Should have been shaving more. But you know what? I'm still in this plan to 2030, and what I have high conviction on. I've actually shaved some of the lower conviction stuff. Some of the stuff I own a little bit less in, that maybe I had a starter position and never filled the whole position of it, things like that. So, all right, cool. Don't buy anything so after the crash it will be bad. Yeah, I mean, that's one mindset. If it's totally up to you. If you think it's going to crash more and you want to try to time it, go for it. I've been doing this for almost 25 years, and I'll tell you that I've never really seen anybody be able to pull that off successfully. You're going to have fake outs along the way too. So the best thing for me personally is I buy at levels, I buy dollar cost average, and I buy at technical levels. I know that I'm not going to time that perfectly, and I'm okay with it. The longer the market stays down, the more shares I can accumulate. That's my school of thought. You have to do what's best for you. There's a lot of people that think waiting for a bottom. If you know how to time a bottom, congrats, because I certainly don't, and I've been doing this a really long time. If you can do it, my hat's off to you. But I've never really seen anybody pull it off successfully. And if you get to that mindset where you're trying to time things in and out, you do it enough times, you're going to lose. It's just a losing game. And me personally, I don't believe in it, but you got to do what's best for you, because I'm not your financial advisor and it's your money. How do you know Rob DCA is best? I agree with you, Jonathan, but like I said, everybody's got their opinion, and I'm not here to try to change your mind. How far will growth or tech stocks go down? Well, I mean, I don't have a crystal ball, so it's hard to say. I mean, if you look at the QQQ, 305 possible short term, maybe it holds this trend line. But, I think most people will tell you that this S3, 250 to 275 certainly is feasible. So you just have to understand the possibilities. To me, it's like, it doesn't matter. It doesn't really matter. I'm going to keep buying at these levels, and eventually it's going to go the other direction and I'll be fine. And if it wants to trade lower and trade sideways for longer, I can just accumulate more. But I understand that that's a really hard game because you have to have extreme mental fortitude, and it's very difficult to do. I mean, it's really hard to do. And, it takes some time, practice. You got to go through some of these. And I know the possibilities, and trust me, I did trim some stuff. I had cash. I, wasn't in a terrible position. I could have been in a better position, but I wasn't in a bad position. And I've actually made some really good buys. A lot of the buys I've made, they dip a little bit lower, but I'm buying like micro doses. Like, for a while there, I was buying like $400 and $500 at a time, on, $1 million portfolio, just really small nibbles. So if I wanted like 15,000 in a stock, I'd buy, 15 to 20 lots at $800 to $1,000 a share, just small nibbles. So that's the key. Dollar cost averaging, the traditional dollar cost average, there's two kinds of dollar cost average. There's periodic, where you just, every paycheck you put in $100 to the S&P 500, and that's periodic. It's just kind of set it and forget it. Then there's the, DCA on individual stocks. Usually you buy like 20 to 25%. So 4 to 5 lots. So say you want 15 grand, you might buy, $5,000 3 times, or you might buy $16,000 of a stock and buy 4 lots of 4,000 or whatever. Now with the market like this, if I'm buying 16,000 instead of 4 lots, I might buy 16 or 20 lots. That's the difference, and you need to understand that. And that's what I'm doing in that Fired Up Wealth Community portfolio. I'm buying fractional shares. I know some of you can't buy fractional shares and it sucks, but in the States, I can buy fractional shares with no commission. So I'm buying $50 of Tesla at a time. I'm buying $50 of Snowflake at a time. I'm just buying little bits every day. And, as it goes lower, I buy a little bit more. And if it goes lower, I buy a little bit heavier. So instead of $50, if it goes down another 10%, I buy $150. And you say, well, eventually I'll run out of money. Eventually you will. You have to be really disciplined with that cash. And, generally you're not investing in growth stocks unless you have a cash flow. So usually you have income and you're still working. If you're retired with no income, that's a tough situation to be in, and you're probably not buying a lot of these hyper growth stocks. So if the market crashes, buy more. There you go. Tech stock with earnings will continue to drop. I think I said that earlier, but at a certain point, things are going to, are too cheap, and people are going to be smart enough to know to buy in. So the high quality SaaS names they're going to have demand at certain levels. I mean, there's no question there. If you look at cloud stocks, they basically came back to the median price. So, I mean, if you look at a graph, it's a chart, it's like all this stuff, it basically, this is the best way I could show it to you on a chart. This is cloud. So cloud, this is the historic price. And if I took a trend line, and said, what should it be worth now? Like if you were just gradually going upwards, and this is just a sloppy whatever, like without that bottom in there. But you might say that cloud stocks, should be worth something like this, like $35 to $40 or something like that. Well, now they're down to 31. So the market overshoots too far on the upside and overshoots too far on the downside, and then you got to say, well, interest rates and inflation make this even discounted more because this is when we had quantitative easing. Okay, fair enough. So how much of a discount is it? Is it 10%? Bloop. Well, there you go. We're getting damn close. It could always go lower. It could go past this S3. It could always go to 0. So there's always lower, But at a certain point, you discount it in to say, okay, here's the cloud Wisdom Tree Cloud ETF. Are these stocks really worth 0? Are there no future, or do they just get ahead of themselves? And maybe they shouldn't have been 65, and maybe $30 is a fair price. Maybe it gets to 25 and you get a deal, and it finds its footing and goes back to 30, 35 over the course of 6 months. Until there's any clarity or catalyst, it's, the market's going to continue to have this sentiment, and I think it's good to understand that the majority of the people that are, you're kind of competing with your peers to buy stocks. And if 90% of them all think it's going to go to 0, well, it's going to put pressure on the market. It's going to keep going lower. But at a certain point as an investor, I'm going to look at this as an opportunity and say, do I want to buy Clorox when it's 40 PS, or if WCLD gets to $25, maybe that's not a terrible price. That's up to you, and I can't decide that for you. What's up, Tony? Seeing the place to be, VIP. You don't know that's the thing, Mr. Market. I've lost many opportunities. Yeah, I mean, and the thing about the market is that if you don't have the right time horizon and psychology and discipline, I mean, the market will chew you up and spit you out. I mean, it's not there to make you do wealth, make everybody wealthy. It's there to take your money if you let it, and that's what it'll do. It's a machine. So, the best way to play the machine is you play that machine long, because that machine long is always going to go higher. Of course, you got to buy the right stocks and buy quality, but the long game is how you win, in my opinion. So, I need advice believing in the CEO of a company's stock. It keeps dipping. Buying to believe in CEO. I'm not sure I know what you mean there, Martin. I mean, the CEO is very important. The leadership's, if you go through the masterclass, I teach all the fundamental, background that I'll do, research I'll do on a company, and it includes, leadership, not just the CEO, but leadership, looking at Glassdoor. There's a lot that goes into owning a stock. Do you see divergence too big to last further between old and new economy stocks? Yeah, I mean, that's going to happen with this type of environment. It's just a sentiment thing, and it'll figure itself out. Really enjoy you. Hey, I'm glad that this is helpful. Again, drop me a like and a comment on the other side if this helps, and more people will get it. The algorithm will spit it out to more people for us. So will we have a reversal this week? I think that you could have kind of a oversold bounce. You could have, they call it a dead cat bounce. There's not really any catalyst for it necessarily to bottom and go to all-time highs, and it certainly could find a footing here and not have to drift lower. The problem is that 90% of my peers tell me that it's going to go lower, so it could go lower. Now, one thing I will say, the caveat to that is that when everybody thinks something is going to happen, it really almost never does. So, it certainly could. Again, in this QQQ, you have to understand the possibilities. It can go lower. You hear me say it can go lower. It could go down here. It could go anywhere, right? So people saying it's going to go down 50%. It could, but what are the chances of that happening? I think it's pretty low, but it could happen. Could it hold up this trend line? It did so far. That's what the algos liked. Does it have to? No. If it came down to 296, is that possible? Yeah. I think the S&P 500, if you look at that 296, we talked earlier about how everything's going back to October 2020. Voila, that blue line is the same exact thing we're seeing in a lot of these individual names. And a lot of times individual names kind of lead you to there. But you have to remember too, that QQQ has things like Microsoft, Apple, Tesla, right? So maybe that's going to prop this up a little bit higher. But most people are going to tell you it's going to go lower. Look for, 275. And if that's what you want to hear, there you go. And you have to understand that's always possible. The S&P 500, it's probably going to, most people will probably tell you it's going to break down to, below $400, and that you could see maybe an S2 398, and then you've got something like 379. The S&P 500 is actually still pretty frothy if you look at it. I mean, I'm not trying to scare anybody or anything, but this is still a pretty extreme move from the bottom. And it's even if I do a trend line off, and if I don't use the pandemic lows in there, my trend line's not working. Must be the live stream. It's broken past trend, and really the trend was up here. It's broken past. So when you do a Fibonacci retracement, like this is, let's see, this is Fibonacci auto. So see style, and you can change these up. This is just trading view. You can go in here and change these indicators and all that. So this is just a Fibonacci. I mean, so it's very possible that it looks like it breached S1, tried to, bounce above that. Your trend line is going to be maybe somewhere closer to 400. Your psychological number is going to be 400, 402 in the trend line, S2, 397, and 380. And any of these things could certainly happen. Oil and some of the consumer staples and things like that, that are diversified outside of technology have held up better. So you got that, you've got that divergence in the market. You got two separate markets, Okay. Not fear of missing the bottom. If you hear my kids screaming in the background, just ignore it. It's Saturday. I probably need to go spend some time with them, but I want to be here with you guys just to give you some information, hopefully help you feel a little bit better about what's going on and understand the possibilities, guys. But again, if you see this chart, just know it can go a lot lower. But then if I zoom out, 10 years from now, the chances of this being much higher are pretty darn good. And if the U.S. stock market is, if that's going to go to zero, like a lot of people are going to tell you on the news, then you're going to have bigger problems. You're going to have zombie apocalypse, and you might as well just, pack it up, go move to the hills and the mountains and buy some Mongolian and, live off the land. So thinking about getting into Confluent. I can't actually talk about that one, but it probably gives it away, right? So love John Deere at these levels. I think under 350 is a solid buy for John Deere. That's my opinion. I'm not a financial advisor. Make your own decisions. Also can't pass up REITs. So Nick, REITs are interesting. I will be using REITs when I get to my passive income stage, but they really are income stocks. So until I'm at my end game accumulation phase, like for me personally, they don't really do a whole lot. If I'm going to buy real estate and I'm young, I'm going to buy a rental property. And I did have 11 rental properties at one point. So, that for me personally, I would rather have rental property than a REIT, but I will use REIT in retirement. So if you're retired, they're great. If you're 25 years old, again, you might have a really low risk tolerance and you might want income for whatever reason. That's your prerogative. But most, young 20-year-old investors probably don't want income stocks, and a REIT, really has an income. It's going to give you income. The price isn't going to really grow that much, and it's going to underperform the market over the the course of 2 decades or whatever. And if you're trying to grow wealth, it can kind of make that hard. So it is good to have diversification though. So most people tell you have some, again, do what's best for you and your portfolio. So painful to see quality growth companies that turn a profit lose like 2 years worth of gains. Well, you got to understand those 2 years of gains though were they were propped up by quantitative easing. And so, that's what I'm trying to explain to you guys. And certainly I've been hurt by it myself, and I certainly have bought some stocks that are red, and I've got some that are pretty beat up, but overall my portfolio is in great shape just because I've been investing for so long, and you're going to get there too. And I've been in your situation, I've been in your shoes before, and it sucks. But understanding why it happened and not trying to blame, Wall Street or everybody else, I think that's the best approach. It gives you more peace of mind and understanding of what the possibilities are and how to handle it on the next, because there will be a next time. Everything in the market cycles up and down, runs up, sells off, runs up, sells off. The opportunities and the wealth that's created in downturns. And of course, the hard question is, where do you buy? Someone said earlier, time the bottom. If you can do that, great. Others will tell you, try to dollar cost average the best you can and just keep working hard and putting money in the market. Some people think that's dumb. There is no wrong answer because it's really up to you. It's individual. That's what I love about investing, is it's so individual to each person. I struggle staying ahead of direction of trends. The market's been brutal. I agree. Seems like Elite Patron is. I'm not sure what that is. A steal. Oh yeah. Elite Patrons. If I would have had something like that when I was younger, like I'd have so much more money right now, guys. I can't even tell you. And I don't want to oversell it. I'll tell you this right now. The reason that there's a fee to get in there, obviously it helps support what I'm doing, right? But the main reason, I'll be honest with you, when I started Discord Patreon, I was still working and I was making $150K base plus commission. That year I made like closer to $300,000. So I quit a $300,000 job to do this, to make $500 a month on YouTube. So you think you're crazy, right? I feel like I'm helping people. Like, this is my calling. I want to help educate you. And I can't do that selling software to, CIOs. I love the job. It was fun. Got to travel a lot. I've got a 4-year-old and a 7-year-old daughter, little girls. I want to be a better dad. I was on the road all the time. The pandemic made me think really hard. And I say, hey, I can make this work. But the main reason that there's a fee to get into Discord is because if it's free, it turns into a shit show. Like everybody joins it and the quality just goes down. You get a million different opinions and you get, trash and spam, and it turns into every other, forum or Facebook group or whatever. And we started as a Facebook community, and once it got to like 3,000 people, it just turned into crap. So this was it's a way to manage quality. If you understand the value you're getting from it, and you understand how much you can learn from not just me, but a community of like-minded people from all over the world, from 40 different countries. And if you don't get it, you don't get it. And you're probably not going to be financially independent someday if you don't understand the value of education. And that's okay. And I can't force anybody to be in there, but that's why the main reason that there's a fee in there is it's a quality control measure. But ask anybody on this that's on here that's in the Discord Patreon. Like, it's not there to try to get a few bucks from you. I put everything into that. 24 last 2 years, 24/7. I'm literally available all the time, answering questions, doing live streams, doing stuff like we're doing now. This is the kind of stuff we do all the time, in the private community. And a lot of it's, typing. Sometimes it's audio podcasts, but we're doing good things there, and we're building what I call the best investing community on the planet. If you want to be part of it, join. And there's my pitch, but I'm just being real and telling you the facts about it. And you can let other people in the group tell you what they think about it, and if they think it's a good investment for them. I think you'll probably get some good feedback. Comfort is essentially these markets, not easy. Man, I'm losing my spot. Oh, there's so many questions. This is great, guys. I'm trying here. Dude, you used to live in Guyton, Georgia? No, I didn't live in Georgia, but I am a Atlanta Falcons fan. You can't see it right now, but there's a helmet over there. I live in the Midwest. I lived in Minneapolis for a long time. Where can we stay on top of your 5K portfolio? So if you join, if you're on a budget, we have a $10 tier Patreon Discord. So go to Patreon Fired Up Wealth. You can Google Patreon Fired Up Wealth, and there's a $10 tier that's going to give you exclusive videos every month, and it's going to give you access to the buys and sells. Now, there's two ways to access the 5K portfolio. If you're an elite or above, there's real-time updates. So like literally when I buy something, within seconds, I copy paste it onto that chat room. You don't have access to that chat room, and you don't have access to Discord if you're on the $10 tier. So the $10 tier doesn't have any Discord. It does give you an email update at the end of every day of what we bought. And then you also get access to the monthly private videos. So right now, if you join right now, you get the Tremendous 12, which is this video right here. That is going to be 12 stocks that I think could be 10x from here based on TAM and just possibilities. It's a really good video. That's about, what is it, guys, 90? I think it's an hour and a half long or something like that. I think it's 90 minutes long. And then we also did an exclusive Datadog. So for $10, you get access to Tremendous 12. You get access to an exclusive Datadog video. That Datadog video is a 60-minute interview with an employee. So you get 2.5 hours of content for $10, plus you get access to all the past buys and sells. And you can go look right now and see everything. There's actually an email that will show you every single link for every single day, every buy, every sell. Oh, we haven't sold anything in there yet, so it's all buys. AMD is a really good pick, I think, here. It might get hit more because of just supply chain and stuff. It might get dragged down with semiconductors, but I think it's under $100 accumulate. I think it's an opportunity. Not financial advice. Do you make your own decisions? I'm not a financial advisor, and I can't make decisions for you with your money. Please consult a legal or financial professional. Which have better potential, AMD or NVIDIA? They're both great. Own both. It's hard to pick between the two. NVIDIA probably has more. They have their hands in more pots than AMD. So what you might not know is that Jensen Huang and Lisa Su are actually related, not like closely related, but like through a grandparent or something like that. So I think that's kind of cool. Anyway, is there still room for things to go down? Yes. Global logistics issues. Yanis, if you just joined, go back and watch the recording because I talk about all this stuff, but let's just recap it. Global logistics issues, you got fuel prices, semiconductor shortages, neon gases shortage, palladium shortages, you got war, Ukraine war, you got China lockdowns, you've got inflation, you got interest rates, you got quantitative tightening, you got all this stuff, right? You got Wall Street wanting to erase Cathie Wood from the history books, Wall Street wanting to erase meme stocks from the history books, Wall Street wanting to erase apes from the history books, throwing in stocks like Palantir into the meme stock bucket, which I don't think Palantir is a meme stock, but it also wasn't worth $30 a share. So unfortunately, a lot of people, bought that thing higher. And I even got convinced that, maybe we bought it at 9 in Discord. I bought some more at 20 thinking, it's had some good growth and 20 is not too bad, but here we are back in, under $10. So question, any risk with continuing to DCA into ARKW? The risk is that ARK could actually just not exist anymore. And I'm not saying that, I'm relaying the possibilities. And there's a lot of people that think that that's a possibility. So, the risk is like if a fund, I've actually owned an ETF in the past, 10 years ago, it was a thematic ETF that had low volume and it lost a bunch of its value. And they basically just gave me cash in my Fidelity account and said, sorry, we closed this fund, Now, I don't think that's an issue necessarily because ARK had $800 million of funds pumped into it so far this year. So people are still buying it. But if those people disappear, then, I'm just telling you, you're asking a question, I'm giving you an answer. I don't think it's going to happen, but there's always a small chance it could. So that would be the risk, is if they just cashed you out and you're at, 50%, you're down 50%, you're taking the L, you don't have a choice. So that's the nice thing about individual stocks, is that, if say you own the same, there's 20 stocks in ARKW, if you own all the 20 stocks, you can decide which ones to keep, ones to sell. If 3 of them went bankrupt or whatever, like, you still have 17 stocks. If an ETF, folds, or if you invest in a hedge fund or something like that and they collapse, well, you're going to get whatever the dollar amount is the day they liquidate it, and it's usually not very good. So positions at a good price, some slightly higher. How to take advantage of housing market bubble. I'm going to have to do housing next time because it's a 2-hour conversation. That's a complicated question, but how to take advantage? Well, common sense would be if there were a housing bubble, then you could buy an investment property, but that's a whole nother topic. We'll do that a different day. Buy stocks and go to sleep. That's probably good advice, I guess. Just go into a coma for a few years and you might not even know what happened, and you'd probably be pretty happy. But be careful. Your brain right now wants to make all these smart moves. Like, I'm going to sell this stock because I don't have as much conviction. I'm going to buy this, and there's nothing wrong with that, but sometimes you end up doing stupid stuff, and then you look back in 5 years and say, I can't believe I did this. And I hear that all the time now. There's a guy in our group, sold AMD, and he was like, what was it, $2 a share he bought it at and sold it, and now, it would have been huge. So NVIDIA is another one. I had a friend that had 100,000 in NVIDIA, and it crashed in 2018. He sold it at 35 a share. I ended up buying the same week he sold, and now my shares are up 500%, and he sold his basically at a small gain, and $100,000 would have been worth about 600K now. So it's a pretty big move. I would personally, got good conversation, guys, good questions. PE and price of sales are distorted from stimulus checks. We talked about that earlier. Fed can print more because we have inflation. Good luck, frown face. I don't really know what that means. Fed can decide between inflation or not, but Dave's like in there pumping all kinds of FUD. I agree with a lot of that stuff Dave said, and I talked about it, but whatever. Tesla's good. I like Tesla, especially under $700. That's just my opinion, not financial advice. Time in the market is greater than time in the market. That's a smart person right there. Late buy here. We'll rewatch the previous hour. Please do. We have a major problem where the Fed simply is not interested in fighting inflation. They're going back and forth. No, Fed actually is interested in fighting inflation. We just don't want to scare markets, but it's inevitable. Well, the markets are definitely scared. So, it sounds like you're in that camp that we got to drop 80%, and that, that's fine. You're entitled to your opinion. Don't fight the Fed. Yeah. So, so basically Dave C is saying, don't fight the Fed, just go to cash and try to time the market and buy in. And if that's what you want to do, that's fine. Go ahead. And, it might work out, it might not. And at the end of the day, it's your money and it's your decision. So me personally, I do what I've always done, and it'll, with time, I believe in what I'm buying, and I'm going to buy more. And, when it gets parabolic, I trim profits like I did last year. And, I'm a long-term investor with the 2030 horizon. So I can't predict what's going to happen, next week, next month, but I know in 2030, what I own is going to be worth a lot more money than what it's worth today. And that's my ultimate goal. And everybody's got different goals in the stock market. Some people are worried about short-term and capital preservation. Some people are worried about, trying to retire young. Other people are, just looking at trying to get dividends and get dividend growth. Some people are trying to get rich overnight and day trade. That's the problem, is there's a million different agendas. You got to choose kind of what your squad is and then try to, align to that squad. Birds of a feather fly together. And if you listen to, there's a lot of different, opinions out there of what's good and bad and indifferent. You got to find what you believe in and stick to that and associate yourself with people that believe in what you believe in. That's what I believe, and I think it makes sense. Best content on YouTube. Yeah, someday people might find the channel. I'm doing my best, guys. So I appreciate the support. Share this with friends. Subscribe if you haven't. Click the bell to get notifications. That way, when I go live streams like this, I'm doing some impromptu live streams. If you click the bell to get notifications, you're going to get an alert right when I go live. And yeah, you can join us in the next one and not miss out. So, and Eric's in the Discord constantly. So much. Thank you. We can be bold sticking to disciplined investing, but when Meta, Amazon takes good earnings and miss, the stock gets, it's just in a bear market. I mean, you got to remember it's capital preservation. People are worried about short-term moves like I talked about earlier. So if you're just joining, please watch the first hour because there's just a lot of information. I kind of went off. My voice is cutting out and my kids need me. So I'm going to go through this. I got another 15 minutes or so here. So hang with me, guys. If I missed anything, I apologize. I'm doing my best to read through some of this stuff. We can be bold, sticking to disciplined investing. Keep up the great videos. Thank you. Can we please look at Roblox? Yeah, why not? I mean, we talked about this earlier, but it wasn't an IPO, it was a direct listing. But when it's coming out of private equity, the valuations are boosted. And so you say, well, everything in private equity was 50% too expensive. It came to retail at $60. So let's cut the price in half. And then when we do that, there's going to be technical damage that's going to take the stock lower. And there's your answer. You know, we're basically right there. And 2 weeks ago, I circled this in chart day and said, you know, it could actually go to 2360. And this was an opportunity to add in this range. So I haven't been adding any Roblox quite yet, but you're getting in that range now. You're at the top of that. So you're at the top of the circle and it could always go lower. It could go to 16, but for me personally, this is where I want to add more for the community portfolio between 23 and 28. And, you know, a lot of these have gotten a lot lower than you thought they would. But again, if they came through private equity, either through IPO, direct listing, or a SPAC, they came to us really elevated and then they got pumped even higher. And it certainly was never worth 140 a share. And now the market wants to reprice it. You know, if it was 60, we'd call it 25. That's probably about where the stock goes. And then it should find a bottom somewhere in that range. And it can always go lower. There's no guarantee, but that's just quick math of what could happen and probably does. So, and then remember technicals, when they get bat damaged, they'll cause additional pressure. So things then can even go lower. So like, you know, this is just nasty. Like this is like not a good chart, right? So, I mean, you know, could it go to $15? I mean, yeah, it probably could, especially it's considered a pandemic play. It's considered, you know, new money. It's considered not profitable. They're burning cash. You know, it's a kid's game. You know, there's all these negative things about it. If you're buying a stock like Roblox, it's probably more of a speculative asset and you're probably holding it for 5 and 10 years and you understand what you're buying, you know, and that's the best I can do. I don't yet own the stock, but SoFi, I can see massive uptick and user growth. So Caleb, SoFi is trading at a little over one price to book. You know, unfortunately, when they got their bank charter, the market wants to put SoFi as a bank. The problem with that is that historic banks have a low PE ratio and they have earnings, so they have a P ratio and they pay a dividend. SoFi, still burning cash in growth phase, doesn't have a dividend, you know, doesn't have a PE ratio. And so it's trading at like a 1.1 price to book when I looked. And I think both JP Morgan and Bank of America are trading at a higher price to book. But in this environment, you want safety, you want earnings, you want dividends. Even bank stocks haven't done well, but that's my quick rationale on SoFi. You know, it probably has a $5 floor or something like that. What's it at now? You know, S3 actually shows lower, 49 and 328. I mean, you could say, I don't think it's going to go to $3, but then again, you didn't think it was going to go to $6. So just, you know, be aware of the possibilities. It probably bottoms somewhere around $6, but certainly could always go lower. It's, you know, if you understand the business and you really like it and you're thinking longer term, it's probably going to be an opportunity. A lot of these stocks that look like this, they're the ones that when you look back in 10 years and you've got like a 10x return, the brave people that bought those stocks, and not all of them are going to work. You might buy a basket of 10 stocks like SoFi and 3 of them might not work out. But even if you get a handful that work out, it's going to grossly outperform the market. These are the ones where you can really make a difference in your portfolio, but you're taking risk, and understand that. You know, and a lot of people bought them higher, including myself. So I have SoFi higher than it's at now. If I don't own a position, I mean, this is me again. I'm not a financial advisor. If I really like the stock and have a position, I'd probably nibble some on the S1, and if it went lower, I'd kind of nibble in DCA. And to me, that makes way more sense than, I'm going to wait till the bottom. Well, when's the bottom? Like, seriously, when's the bottom? You think you can time that? Like, you really think you're that smart? You know what that's called? It's called the overconfidence effect. Morgan Housel. Go look up his book and go read that. It'll be enlightening. Been listening, finally made it to desktop. Appreciate your chart analysis on net. Curious if you could share your opinions on Upstart. Quick thoughts on Delo. Delo is probably an opportunity, but it's got risk and it's still expensive. It has a P ratio, but it's a high P ratio. It's not very well known. It has international exposure, and it is what it is. Delo, probably an opportunity. Also can go lower, just like anything else. Upstart, we thought maybe it would even get down here in the circle. It didn't. It bottomed out here closer to $71. This is old from a chart day. I said I would watch for 75 retest. Well, it basically went down to that, and this was a while ago, so it ran up to $100 or something. I said maybe retest to 75 because it was 75 back here, and it did that. It's retested that. So it looks like it's trying to hold that retest area. If it breaks down, you've got this range from $40 to 75. Got somebody calling me. I could see this at $50, but this is one. This is on the Tremendous 12. So again, and you can rent this if you don't want to join the Patreon. The Patreon's a better deal because it's $10 and you get 2 videos. But you could also go to Gumroad. So in the description of the video, there's actually a link for all Fired Up Wealth links, and you can find my TikTok on there. You can find Facebook. You can find Gumroad. Gumroad, you can rent this. You can rent the masterclass. Go check out all the links. There's a ton of links. A lot of them are free. Some of them are paid. Go check it out if you think this content's good. There's a lot more of it out there for you to consume. And the channel, of course, on YouTube's free, and I've got hundreds and hundreds of videos. Been doing this since May of 2019. So I'm going on. This is actually my third year anniversary this month. So cool stuff. So that's Upstart. I mean, it's either going to be a $400 stock again someday, or it's going to go out of business. It could be a 10x stock, and it's going to come down to, I've said this many times, but you've got the risk with, first of all, the AI. So Zillow Group had AI for their estimates. That ended up not being as good as we thought. Stock got hammered. So that's one risk. Is the AI as good as we think it is? Mortgage default, or not mortgage defaults, but so they don't do mortgages. They do personal loans and auto loans, but if we go into a recession, are there going to be more defaults? Those defaults going to impact Upstart. How does that look? COVID comps. Everybody was buying cars, right, after the pandemic. So their earnings were boosted. What happens now when earnings decelerate on a hyper, growth stock? Even though this does have a PE, it's an expensive PE. It's a unproven name. So when you think of Microsoft and those kind of names, people, it's proven to them, it feels more of a safety stock. They're going to put money in Microsoft. If the whole market's beaten down, I'm a money manager and I'm looking at 1-year returns, I'm going to, probably look at Microsoft, because Upstart in the short term, who knows? Longer term, zoom out the lens, 5 years, this is either going to make you a lot of money or it's going to go to zero kind of a thing. And there's a good chance it makes you a lot of money, but you're going to take risks on by investing in a company like that, because it's a newer IPO. If you look at this, it started trading in December of 2020. It was about $30 a share, and it rocketed all the way to 401. And it's made this round trip, not complete round trip, but it's came back now to 71. So pretty intense trip there on that one. Roller coaster, like a lot of them. I joined late in the live stream. Want to share my opinions. Okay, Dave. I appreciate it. I didn't mean to come off that way. You got to understand, doing what I do, the last 5 months have been, especially the last 2 months. I mean, it's absolutely brutal. And most YouTubers, guys, they're running away and they're going into their shell because they don't even know what to tell you, because they don't know half the stuff I'm talking about. But they're getting hammered by, anybody that bought a stock that they want someone to blame, they'll go onto a YouTube. And luckily for me, I've always taught balance, and I've always said, like, it can always go lower. It's always, if I'm talking about a cloud stock, it's like, these are really expensive stocks. And if you're buying them, they're probably spec unless you understand it. And you probably have a 5 or 10 year time horizon. Like, no, I was not telling people to buy Cloudflare over $50 a share. It was, 40 and under. CrowdStrike, same kind of deal, 100, 125, kind of a thing. So somebody just like tipped me or something. What the hell is that? I've never even gotten one of those before. Giannis, thank you. $10. Woohoo! I appreciate it, buddy. Let me see. So let me finish. Ooh, I got another boost. Thanks for your. What's going on here? Good things happening. All right, let me go through this. I'm gonna hit these chats real quick. So thanks for the videos. I'll make sure I don't miss anything. Give Eric a thumbs up. Thank you, Brad. Any thoughts on Pubmatic or MP? I'm a fan of Digital Turbine and Trade Desk. I think Pubmatic and MP can do okay. I know those other stocks better, and I've done a lot of research on Digital Turbine. Go check out the channel. There's 2 deep dive videos on those. But I think that whole space has opportunity long term, but I also think there's risk because if there's a recession and money slows down, advertising dollars can slow down, right? Because the consumer might slow down. So you got to use your brain and say, hey, wait, if I'm going to categorize what I'm going to buy right here, what makes most sense? So I've ranked in Discord like what makes sense to buy here versus like I really like Etsy long term, but it's not a great stock to be just loading up on right here either. You know, nibble here and there, but I'm not like loading up on it. Probably going to go lower, and I'm probably going to have more opportunity to buy it later. Like some of these business to business type names, especially enterprise software, you know, those are going to do well regardless of the environment. Like if I'm a CIO, I'm not going to like rip and replace software. If anything, I'm going to buy more software and get rid of employees and headcount, you know? So yeah, I would focus more on B2B. That's just me personally. Anything that's B2C, from e-commerce to fintech to advertising, I just think you have to be a little bit more careful and understand what the possibilities and risks are on those. So what do you think about taking losses on high flyers and concentrating on high conviction? I've done some of that myself. So if you've got smaller positions and things like that, I think it can work. It's up to you. But you know, if you've got, say, a small starter position and it's down 20% and you need cash, sometimes. But here's the thing: if I do that, I sell and buy the same day. So if I want to sell something that I have a small position on and I raise $5,000, I take that $5,000 the same day and I buy something else when everything's equal. So what you're doing then is saying, well, this is beat to crap, but this is beat to crap. I'm just going to take these chips from over here and put them in this because I have more conviction and I'll actually improve my cost basis on this one. I can tax loss harvest. And that depends on you too. Do you have the ability to tax loss harvest? Like I do, because most of my money that I talk about on YouTube and everything, my retirement's all ETFs. So I don't have to worry about that. But my individual stocks is all in a taxable brokerage. So I have the ability and the luxury as a US person to tax loss harvest. So if you're not familiar with tax loss harvesting, let's say you're up 10,000 on a stock and you're down 10,000 on a stock, you can sell both of those stocks and get the cash, and then you have a zero tax liability. And you can offset those unlimited. If you have losses, you can take $3,000 and use that as a deduction on this year's tax return. If it's more than $3,000, you got to carry it over. So if you have a $6,000 loss, you take a $3,000 loss this year and a $3,000 loss next year. The best thing is have gains. Now, this is what's hard if you're a new investor. You might not have a ton of stuff that has gains, especially if you didn't diversify appropriately and you only bought 5 stocks and they're all down. Well, now that's tough. In my situation, like I can still sell something like Elastic and still make 20% gain on some of those stocks. Like Blackline, I'm still up 20%, and it sucks selling them down there, but I'm taking a small profit where I only have like a $5,000 position. I'm putting that into something like a Snowflake, even though it's really expensive. You know, and to talk about Snowflake, so we were always very cautious, try to buy it under 200. And I have about a 2.5% position in my portfolio, and I want it to be 5%. So my cost basis is under $200. It's $150. I think that a lot of people want the Snowflake to go to $120. So like, I'm not saying that has to happen, but you have to realize that that was the IPO price, and that could happen. So like, this is a really expensive stock, and for most people, it doesn't make sense to buy it because you don't understand it, and it's probably speculative. But just know this thing could go down. I mean, it could even go to 100, but it's very possible that it comes down in this circle. And I circled this a while ago, and this S3 is 122. I'm not going to be surprised if that happened if the market rolls over. Now, if the market finds footing and we have a catalyst and goes higher, well, the bottom's in on a lot of these names. But if the selling continues, well, then here you go. Here's this circle, and this is where I would want to load up my other 2.5%. And then if I load up my other 2.5% and it goes to 100, well, it is what it is. And if I have $160 cost basis, I can live with that, and I think I'll be just fine if I'm holding it to 2030. That's just me, right? But I have a lot of conviction in this company, and I will tell you that most people should not buy stocks like this because they're roller coasters. You might not have the appetite, and you might not understand them. So when they go down, you don't have the conviction, and you're just going to lose sleep, at night. So I've got a couple of different things I need to skip to. This is your best stock to invest in right now. You join Discord and you'll know the best stock. Boost it forward. Hey, I appreciate it. Thanks for your time. In this type of market, what are your personal 5 highest conviction stocks, financial advice? Well, normally I would say, and I'm not going to answer this question directly, but since you paid $5, I'm going to at least give you something. So right now, for me personally, here's the thing. Cloud SaaS stocks are still expensive and they could go down further. But if I look at the valuations on them now, and I look at historic metrics, they're getting more affordable. And so just like Snowflake that I just talked about, I'm dollar cost averaging at these levels. It doesn't mean they can't go lower. It doesn't mean they're not expensive, and they might not be the right stocks for you. But I'm focusing on B2B and not B2C. So I think Snowflake, I'll give you 3, okay? Snowflake I really like, still expensive, can go lower. Okay, Datadog, really like it, had a blowout quarter. If you have not watched, I have a video on YouTube that's free, 20 minutes, post earnings. Go on the channel and watch Datadog. That's a really good video, and it gives you a lot of great information. If you want to take it even further, I've got a 1-hour exclusive on Patreon for that $10 tier. You can get access to that Datadog video. So you could go watch 2 Datadog videos today and spend an hour and a half and have a really good understanding. They're ridiculously expensive, so I don't want you to not hear me say that. Both of them are really expensive, and they are high risk stocks, and they can go lower. But I personally worked in software and SaaS, and I understand the total addressable market. I understand the bell curve, and I'm confident that they're going to be worth more, even though they're expensive now. They're expensive for a reason, because people understand the quality and the total addressable market. And then AMD had a really good earnings report. And, it could get pulled down lower too. But I mean, if out of those 3, the safest one, because it has a PE ratio, it has tons of cash, billions of dollars of cash, it's still expensive. I think it rocks like let me just look it up so someone doesn't say, Eric said this. AMD stock, what is the PE ratio right now? Just a quick Google search, it says 35. So 35, or you can buy Clorox at 42. Which one do you think is going to be worth more in 5 years? Choose your battles. NVIDIA I still like, still expensive, and then Airbnb is one that, if you understand Airbnb, it's still expensive too. Well, there you go. There's 5 names. So, I mean, I like all those names. I have high conviction in those type of stocks. I think Google's a great stock at 20p right now. If you want more on the value side, I like names like John Deere, Tractor Supply. I think Wingstop, it's still expensive, but Wingstop is getting, closer. And I just gave you a lot more than 5, but I can't give you the 5 in order. I just don't like playing that game, but those are all stocks that I like. I'm more of a basket guy. Buy, 20 stocks, knowing that some aren't going to work out and you're going to make money as a basket. That's how I play it. So thank you for the tips and stuff, guys. I really appreciate that. Yanis, $10. I got $20. I've never made money on a live stream in my life. So I think this is awesome. So I thank you guys very much for the support. I was not expecting that, and I really do appreciate it. So what would you advise for investors jumping in the market now in terms of percentages between ETFs, growth, spec, and crypto? Have you discussed this in previous videos? Wonder what you think. So I've got a video series, like how to build a growth stock portfolio from scratch, and it doesn't include crypto, but it would probably be similar. Like, you have to decide your age and your risk tolerance and stuff. But I would probably, I would do a blend of ETFs. Maybe you do, when you're really young and you're aggressive, maybe you only do 25% ETFs or something, maybe less. Dividend stocks, maybe you do 10 to 20% dividend stocks. Then you got growth stocks. Your spec, especially in this environment, I'd probably minimize your spec to 5, maybe 10% max. But spec is going to be stuff that's really expensive. Like maybe even the cloud stocks might fit in your spec bucket if you didn't work in SaaS and don't really understand it as much, whatever. And then crypto, for me, I've got a couple percent of my net worth, and I bought Bitcoin and Ethereum in 2017. I got some Decentraland, some Mana. And I do have a few other smaller altcoins, but you understand that those are, I feel those are very speculative. And, some people have 80% of their money in crypto, and that's your prerogative. Like, I can't tell you what to buy or whatever, but I do believe in having some of that in your portfolio. I don't think there's any reason not to, but I just personally don't go too heavy on it. So I might only do, 2% or something, but you might want to do more depending on your conviction level. So I know that wasn't exact answer of percentages, because the percentage really is going to matter to the person, but it gives you kind of a blueprint to start with. So, if you're trying to be really aggressive, you might have, 20% ETFs and 10% dividend stocks, and that leaves you with 70%. So you might have, 60% in growth, 5% in spec, and the rest in crypto or whatever, if that math checks out. I think it does. Would you advise, I can't advise anything. Investors jumping into the market now in terms, okay, I just read that one. I've been a fan since you began. Love how you truly are in it to help people. Not many can say that. Thanks, brother. Thanks, Lance. I appreciate that. Do you do TikTok dances? No, but I do have a TikTok. I had 650,000 views on TikTok in 2 months, and it's doing much better than my YouTube channel. It's sad to say, but it is. I don't know why, but I guess the attention spans, I don't know. Let me just go back up here. So first of all, thank you, Boost It Forward. Thank you, Giannis. There's another one I need to get to as well. We are adding to our portfolio DCA 10K thanks to my kids, BAM Media. Hello, Eric. I started investing April 2020. My portfolio of hypergrowth stocks is down 34%. Is it down 34% from the top, or are you actually down 34%? If you started in 2020, you're probably still up. So keep that in mind. It's all perspective. At one point I was up much higher too. Like if I'm at 1.75, $1.8 million and it comes back to 1.2 million, you're like, oh my, $500,000, right? Well, yeah, but it also was $500,000 that was basically paper gains, and now it's paper losses. And you could say, well, you should have sold, you should have done this, should have done that. I'm a long-term investor, and I still have conviction what I own is going to be worth a lot more when I need the money, and I don't need the money right now, and I don't want to pay the taxes right now. So again, it's all personal, up to you. If you can, if you want to time in and out of the market, preserve capital, trade, day trade, whatever the heck you want to do, the market's there for you to do it. Everybody's got their own strategy, and you got to do what's best for you. I'm going to lose my voice, but I'm going. So I've been reading Peter Lynch and getting frustrated with investing. The thing, you got to think long term, though. I mean, Peter Lynch would tell you, if you read One Up on Wall Street, that you're not going to be right every time, that you're not going to time the market, that you got to have that discipline and that psychology to weather the storms. And I think you just have to understand, if you go watch this recording from the start, you'll have a better understanding of why the market's doing what it's doing. And I think just understanding what's happening gives you a better feeling about what's going on. So, because a lot of it's fear, because you just don't know. And then it's that fear, that unknown of like, is the market going to go to zero? Is it going to go lower? Is it going to do this? But when I look at the U.S. economy, is it going to expand over the next, when I need the money by 2030? I think it is. And some people will say, well, we're going to go into a 10-year bear market and blah, blah, blah. I mean, that's always a possibility. That's why you don't invest money you can't afford to lose. But I don't need that money that I'm investing. And I'm trying to, the number one thing I always say is, why do you invest? Do you invest to make a quick dollar, or you invest to try to make yourself have a better future for you and your family over time? Most of you have 10, 15, 20 years in front of you to invest. You think about all the times the market's done this before, from all the way back to the 20s, and we've had some massive crashes. And this is what scares people, because it's like sometimes you have these big crashes, it takes a long time to get to the other side. But if you're buying that whole time and you're confident that there's going to be another side, there's light at the end of the tunnel, you don't have to really stress out that much, right? What you do is you look at it as an opportunity to accumulate your favorite companies. Make sure that you're buying quality, guys. Don't buy junk, buy quality and stuff you really believe in. And if you don't believe in it, you shouldn't have bought it in the first place. And this is where you might have to make a tough decision of like cutting something and putting that capital otherwise. One of the top 15 investing rules is that the story changes. Cut your losses, reposition that capital, and pivot it, and you'll do better. And I'll give you an example of that. Okay, this is an example. I'm transparent. I'll give you an example. Here's one of the biggest mistakes that I've made in my investing journey. Grow generation. Okay, so last year, this thing ran from like a penny stock for $2 in March 2020. And it ran to $67. Now, I wasn't buying $67, but I was buying like basically when it came down. So what happened was the stock ran up to $67 and it started breaking down. And so then a lot of us were buying this stock like, I don't know, let me see. Don't quote me to this exact level because it's traumatic. I've got PTSD and I've tried to zone it out of my brain. But probably like, in this range, like all the way from like 20 to 30 bucks. And I remember buying in here and just it kept going lower and lower and lower. And then we got to the end of 2021 and I had to make the decision of what to buy or what to harvest. And so it was actually, and it was 25 and it was like, well, if I sell it now at, I think it was like 18 or something when I sold it. If I sell it at $18, the thing's probably going to shoot back up to 30 next year and I'm going to kick myself in the butt, But I'm like, you know what? I've looked at this more and the story really has changed and I made a mistake. I really did. I shouldn't have bought it. And I kept throwing cash at it. So like it would go lower and I'd buy more thinking I could like buy myself out of my bad cost basis. And this is a huge problem. Now, luckily for me, as I'm super conservative, so usually I buy 1% to 2% in a stock. So even if it goes to zero, it's like, I'm not going to break the bank. But this one did get to like 2-3% of the portfolio at one point, and it was too big. And I had, a decent loss. I think it was like a 40 or 50% loss. And so I actually sold the majority of the shares, basically all the shares, significant shares, at the end of the year. It was like, $17, $18. And I remember that was so hard. And now I look at it and it's a $5 stock. So it was a good move because I used that capital position to something else. And whatever I bought probably is lower now too. But I had way less conviction in this stock. So, you've got to sometimes pivot that capital. But if you have conviction in a stock, like say I'm putting money in NVIDIA, everything has risk. There's no such thing as a safe investment, not even bonds. Bonds are down 11% this year. If you had a 50-50 portfolio of stocks and bonds, you're still getting your butt whooped this year, guys. There's not really anywhere to hide unless you're in commodities. There's just not a lot of safe places to hide. But if I'm in NVIDIA, this thing ran hot, and I think this is an opportunity probably in here. Maybe it goes to 161, 175. The lower it gets, the better the opportunity. It had this stock split. It was part of the whole euphoria of the retail investor that we were all involved in that took it to 345. Now, I was telling the group, I made a video on NVIDIA when it was basically under $200 around this time. It was like basically the price it's at now. It was last summer. You can go watch the video. It was July or August. It was somewhere in this range. And I was telling people like $150 to $200, I really like the stock. It was expensive, but I really like the stock. They were going to do a split. And it was more than that because they did a split. So it was a larger stock price than it is now, blah, blah, blah. You get it. When you do these stock splits, you take a pizza and you cut one pizza into 20 slices. It's still one pizza. You're not getting more pizza. If you get a pizza and you cut it into 20 slices, you've got one pizza. It's cut in 20 slices. That's all a stock split is. But retail loves to think they're getting more of NVIDIA or something like that. I remember when Tesla did their split, somebody told me on YouTube, I'm going to buy a bunch of Tesla, and it worked out for him. It worked out for him, but it was for the wrong reasons. And the reason he said he was going to buy a bunch of Teslas, it was splitting. And with the split, he was actually going to own part of the Boring Company, and he was going to own part of SpaceX. And I'm like, bro, no, you're not. You don't get. Those are private companies that have nothing to do with. He's like, well, yeah, but Elon Musk, he started those businesses. With the split, we're going to own all those businesses. I'm like, dude, who told you this stuff? I got it on Reddit, and I'm like, no, no, you're literally just taking a pizza and cut it into 20 slices. That's a 24 stock split. So you have to be careful with these stock splits. They're great for traders because traders will ride the momentum and then they'll sell these tops, make cash. But if you're buying it as an investment, you end up being kind of the bag holder. But I think that this, if you look at the overall trend and you just look at the flow of this, it's, let's just do a trend line. You guys like charts and trend lines? It doesn't mean it can't go lower because with quantitative tightening and not quantitative easing, it drops the value of everything. So maybe the market wants to put it back to 120, but I doubt it because this is a high quality stock and money is going to come into these kind of names first. So this is what I call tier one. But the point was, if I buy NVIDIA at $175 a share, am I losing sleep at night, worried that NVIDIA is not going to be worth more than $175 a share in 2030? It's possible they get disrupted. That's why you watch earnings reports or you listen to earnings reports. You stay on top of your investment. So part of being an investor, you don't just buy it. People that say buy and hold forever, you buy, you hold, and you monitor. And when the story changes, you sell and you get out. And nothing lasts forever. Look at the S&P 500. The top stocks that were in the S&P 500, the only ones left are the ones like Microsoft that are still kicking butt. But a lot of those companies roll over. Their stock is hot. Enron used to be the stock to buy. Now it's worth zero. Blockbuster used to be really cool too, and stuff gets disrupted. So NVIDIA right now, NVIDIA is a disruptor doing great things, and they're in AI, robotics, cloud computing. They're in, metaverse, crypto, like every secular growth trend you can imagine. NVIDIA is powering it. I call semiconductors the new oil, and I've got a whole series of playlists on the channel called Semiconductors New Oil. It goes into deep dive on, AMD, on NVIDIA, on all of my favorite, semiconductors. And these they're having issues right now with supply chain and everything, but you think of technology, this is the simplest area for me to invest in. They're considered cyclical, but think about it. The microphone I'm talking in, the monitor you're looking at right now, your phone that you're holding, your car, all this stuff requires these semiconductors, and it's just this huge secular mega trend that you're going to make money on. Pretty much any name, go buy a semiconductor ETF. I think you're going to do pretty well on those over the next 5 or 10 years. But maybe that technology is disrupted. At some point, maybe it's disrupted, and quantum computing could disrupt blockchain. Quantum computing could disrupt cybersecurity as we know it. And you have to be, as an investor, you have to stay in front of this type of stuff. But right now, as of today, with Jensen Huang alive and well and at the helm of NVIDIA, I feel very good buying this company and holding it for 5 or 10 years. But that story could change along the way. But that's the stuff you want to own in your portfolio that just feels like a no-brainer. And sometimes you're still going to be wrong. But what you don't want is like, well, I've got this, XL fleet that was a SPAC and, it might recover someday. So it's $1 a share now. I'm just going to keep holding it. Like at some point you just got to move on, you got to cut your losses and just realize the story changed. You were wrong. You got to admit you're wrong and just kind of move on. So, all right. I don't do TikTok dances. This is help, all that kind of stuff on Patreon. Thank you. Apps is awesome, but getting killed like everything else. Been watching the past year, enjoyed the shows, especially since I don't know a lot about tech field. You've taught me a lot. I'm glad to hear it, Bill. Christopher Moore with a $19.99. Look at this. This is history in the making. So thank you, Christopher Moore. You do an outstanding job, level-headed, and very measured approach. This guy, Christopher, doesn't even have a question for me. He just wanted to give me $20. I feel it's pretty special. So thank you very much, man. That is really cool stuff. I'm not currently drinking, but if I were, I would go buy my favorite IPA. I'm on this diet right now. I've lost like 30 pounds in the last month. So I can't eat anything. I can't drink anything. I can't drink alcohol. I can't drink soda. I can't drink caffeine drink or energy drinks. I'm working out 2 hours a day, and the market is just going down every single day. This has been my life now, for the last month or so, and it's just like nonstop. So I'm still holding up. I'm doing well. I'm doing my best. I'm not ignorant to the possibilities of what could happen, but I'm very optimistic about the future of not only the businesses I own, but also the American economy. And I'm an optimist. Maybe I'm wrong, but don't kill me for being an optimist, because there's not many left. And I'm proud to be one of those that I actually think that we're going to see a pivot here, and you might be surprised at what happens next. And there's very few people in my camp, Blue Suit Dylan on Twitter is one that's in my camp, where it's like, if the Fed starts to see, certain cracks, they're going to have to make adjustments. And inflation is a supply and demand thing. So I'm not saying that inflation's not running hard. What I'm saying is, who knows? CPI, is it going to be, maybe it'll be higher next week, but I won't be surprised if we've already reached peak inflation. You look at, like used car sales and some of the stuff we look at under the hood and the CPI. It really, CPI is just inflation of consumer, inflation, CPI, consumer price index. And you look at some of that data, and it's like, some of it's starting to ease off. So maybe we've already reached peak and we're starting to go the other way, and maybe all of a sudden we're not having to raise rates. And now the market's, you still have the quantitative tightening issue, but you might be surprised. I'm not saying we can't go lower, but also, there's not many people out there that try to explain the positive sides. One catalyst, Russia, Ukraine war ends, whatever. There's a million different things that could happen. But right now, the market doesn't have any of those. There's a lot more reasons to be bearish than bullish. And so it's going to continue to have volatility and probably continue to sell and probably continue to go lower. But just, I won't be surprised if there's one little, event, a piece of information or data, that's a catalyst that might make the market bottom anytime too. So, and when it does, it's hard because sometimes it snaps and you get those fake outs, those bull traps, and then you got to be careful chasing. If you're sitting there waiting for a bottom and then all of a sudden it looks like a bottom and you start chasing, next thing you know, it gets sold and then it goes to a lower low. So be really careful of that, because that's something in bear markets that happens over and over again. And you get these really strong rallies that look like, oh, it's the end. So you've got this despair. You're like, oh my God, I'm so stressed out. I'm worried. And then it starts to bottom, and that might happen next week. It happened Monday. And you're going to be like, this is the bottom. This is it. And maybe it is. It could be. But just know that if you look at history, a lot of times those things get faded, because there's still people. Why do people sell? People sell because they're afraid of what's coming. The market's forward looking. So someone asked about the real estate market. Well, if housing starts crumbling on top of this, because you think interest rates are going up, so people have less affordability, rents go up, so now there's less consumer spend because there's less disposable income. Well, what drives the American economy? It's the consumer. We're a consumer-driven economy that loves to buy Starbucks and just buy stuff we can't afford. And it sucks because I'm a guy that tries to teach financial education, but I also understand the economics behind it. Like, that's really what fuels the economy. You take out the U.S. consumer. We already know that e-commerce is starting to slow in areas. We heard from Etsy and Amazon. So you've got supply chain issues, prices high. You've got all these different, currents whirlwinding underneath the surface, and just trying to grab you and pull you under. And you can easily get pulled under and not be able to come back up for air. So understand that. And that's why a lot of people are just like, sell here. The problem is, like, if you're going to sell, it could go a lot lower. But for me personally, you would have already sold the last rip on, in March. And if you really believe that this stuff was all going to come to fruition. So understand the risks. If it goes lower, you can't panic, because I'm telling you that could happen. If it runs higher, know that it could be a fake out. It doesn't have to be a fake out, but just be careful chasing stuff that goes up 20% in a day and then getting crushed, having it go back down 30% the next week. And that can happen. You get really violent bull market runs, and you'll see basically a pop up, and then you'll see a pop down, and it just kind of takes a leg lower sometimes. And it doesn't have to. It really doesn't have to. One catalyst could make this whole thing go the other direction, but right now we've got more reasons to be bearish than bullish. All right. I sell and buy the same day too, but still getting killed. True saying, if you bet, keep the bet small. What's up, Connor? How long does it take for cloud stocks to grow into current valuations? It depends on the cloud stock. But yeah, I kind of made an example earlier with Cloudflare. If you didn't watch it, go watch the recording of it. We kind of talked about that. I'm retired, have no salary, so I have to be very disciplined. Yes, you do. You have a different risk tolerance for sure. I'm confused. You're a long-term bull or bear at this point in the stock market. No reason to be confused. I think I'm very clear that long-term I'm a bull. Short-term, the market could go lower. That's as simple as I can put it in 2 sentences. So thanks for the answer. Actually gives me an idea. I mean, I don't have a crystal ball. Nobody does. If someone tells you they know for sure what's going to happen, they're full of crap, because nobody knows. I mean, I can't call a bottom, and I'd be foolish to go on a live stream that's recorded on the internet for the rest of my existence telling you that I know for sure it's going to bottom. I'm telling you some really good points here to consider and some possibilities. And that's all it is at the end of the day, because nobody really knows until it happens. And it's easy in hindsight to say, I should have done this, I should have done that, but you're just going to mess with your head. First of all, I'll say this. You shouldn't stare at your portfolio every day. I know half of you do this, probably more than half. It's not going to do any good, right? You either decide that you're going to sell and get out and just move on with your life, or you stay and understand that you have a long-term conviction on what you own and that you have a long-term horizon, and you don't stare at it all day. If you want to buy a stock, you use watch lists, you use limit orders, put in limit orders. But staring at your damn app all day, imagine if your house had a ticker above it, and everywhere you went, the house had a ticker like, oh, my house went down $10,000 a day. Like, that's just silly. Warren Buffett talks about, if you're going to buy stocks, if you're not comfortable with losing half of your value overnight, then you shouldn't invest. And in Berkshire Hathaway invests in some pretty safe stuff, low risk, risk adverse type stuff. And Berkshire's had drawdowns of 50% before. So if they can have a 50% drawdown, if you're a hyper growth investor, just know that you can certainly have a 50% plus drawdown, and we're not there yet. So that's where people that are pumping all this fear, uncertainty, and doubt, and that FUD, that's what they're talking about, because it absolutely is a possibility. But the other side of that is it's possible it could literally bottom tomorrow. And I don't know how to time that, and I'm not going to try to time it. Look at how much money that Buffett's accumulated over the years. And of course, he's not buying hyper growth stocks, but wealth accumulation works with or without dividends. I mean, you have $1 million and your $1 million goes up 10%. Now you've got 1.1 and, you get the math, compounding works. So, and I think dividends should be part of your portfolio too, just not stale income stocks with no growth. You got to have some of that, what we call DGIF, dividend growth investment fired. So it's got total growth, growth on the dividend plus growth on the stock. And I could talk about this stuff all day, but I need to keep going. So I am losing my voice. Brad, thank you for the $10. He says you should, so Brad Needleman, you should do more live streams. You're good at it. Thanks. I appreciate that. I've had a lot of practice over the last couple of years doing the Patreon Discord. Every, 3 times a week we do live streams. So I definitely am a lot better at YouTube too, more natural. I don't edit nearly as much. I used to have to spend hours and hours cutting, and now I feel more comfortable on the camera. It's like, if someone wants to hate on me, whatever, man. If you got nothing better to do, come on here and troll me, then, I feel sorry for you. I'm just trying to help. You don't have to agree with me. The people that are jerks, anybody that has anything negative at all anymore, I just block them. I don't even try. So just know that if you're going to come and you're going to do something stupid on the channel, you just hide user from channel, and you want to make another account, I'll just keep hiding them. It doesn't matter. No one's going to see it. And it's not going to hurt my feelings. So, it did in the beginning. Now it's just like, you know what? It is what it is. And if you can't see that I'm trying to help, then, I can't help. I can't do anything differently. So I appreciate it, Brad, for that. Are you expecting for Blend Labs? So Blend Labs is a tough one because it's always been a spec stock. So very speculative. It's in your spec basket, very controlled amount. I do own some of that. Of course, I'm red on that one. Had the ability to actually interview the CEO, which, certainly held my conviction, but it was a new IPO. We talked about this earlier. Plus it's involved with housing, right? Housing is going through a potential storm. And, you listen to the last earnings report on Blend, Nima Ghansari, the CEO, told us that mortgage applications slow down. Well, if you take mortgage rates and you increase them, you double the mortgage rates, it's going to slow down. And their business relies on title insurance, on mortgages. That's how they operate. So if there's a housing crash, like somebody suggested earlier, well, stocks like Zillow Group and Blend Labs are going to get crushed. And these are going to be cyclical by nature. So understand that. So you would, if you believe in that company, it's something that you'd have to try to ride the cycle on the way up, and you'd have to really be buying that stock when the cycle goes on the other side. If you're putting the capital to work right now, that's not probably the best place in the world to put capital, although the price, I said this yesterday in a live stream in Discord, the price to book is 0.75, meaning that if it actually sold all their assets, they would actually sell their assets at a 25% discount. So it's selling literally less than, banks that trade at 1.2 price to book. So, and that was a stat I got off of just a quick Google search. So maybe the number's wrong, but if that number is accurate, which I think it is, it's pretty incredible. So, and this is what bear markets can do. It gives you a lifetime opportunities sometimes in these names, but who right here has courage right now to go buy Blend Labs? Nobody, including me. And someday if that stock's, $40, you'll look back and say, man, and you do it all the time. AMD, everybody wants to buy it. That thing was a dog. Tesla was a dog, 2018. No one wanted to touch that thing. It was going on. Ask anybody in 2018, 2019, Tesla's going bankrupt. There's no doubt about it. They're going bankrupt. And now everybody wants to buy Tesla. If you would have had that conviction back then to buy it, that's where all that money's made. A lot of the famous YouTubers that you guys watch, they made their money in Tesla, and take Tesla out of the mix. Even people make the argument with Kathy Wood, with ARK, was Tesla and Bitcoin really the only 2 home runs? I'm not trying to throw Kathy under the bus. And I was even going to look at ARK funds here if we had time and kind of show you year to date down 30% expense ratio. I was going to show you some of the top holdings and stuff like that, but we're kind of running out of time. Tesla's still the top holding 9%, Roku. Roku had a decent quarter last quarter. Zoom is trading a 22p ratio. Coinbase, it's man, some of these could be big still. It's just a lot of them are pandemic fueled. The sentiment's bad. UiPath, another one's just been absolutely murdered. So thoughts on CPI report. I have a feeling that it'll probably be in line and might even slightly be under. But at the same time, if you told me it's going to be higher, I mean, I won't be surprised at anything, to be honest with you. There's just no way to predict it, no crystal ball. But I have a feeling that CPI might start cooling down just based on my research. But there's really no way to know until you actually have the data. So more stock splits on companies you own. Can Tesla go back to 750? It already went to 700 in March. In fact, I put a limit order in Fidelity for like $725 and it filled it at 700. I was like, what? I'm like, I'll take it. So I bought more. The first time I bought Tesla was back in 2020. I did a video like I'm putting 20K to Tesla, and it was before the split. It's run a lot. I don't remember how much it's ran, but I think it's up. I think it's still up 200% or something. And I added some more at 700, and it was just completely lucky. I put the order at 725 and it filled it at $700.00. And I even posted the screenshot in Discord. I'm like, I love Fidelity. Like, they're taking care of me like that. That's a big, and I don't remember how many shares it was. It was like, 10 shares at $30. I'm like, I'll take $300. All right. So thoughts on CPI? Thank you. Brad says, thank you, Eric. I have a different approach because I have a shorter time frame. But your approach is right on. Yeah, I mean, I get it. Like if you have to preserve capital right now, you're probably playing this a little differently. I get that. And this is where you're going to have arguments of what's right and wrong, because most people are going to tell you the market's going to take a leg lower, like just raise a bunch of cash and buy it lower. But, it's tough because it doesn't always work out. If you have millions of dollars and you're trying to preserve it, then that's what most financial advisors would tell you. And I'm not a financial advisor, but that's what a fiduciary would tell you. Understand that their job is capital preservation and 1 year returns, and your job is probably appreciation and 10-year returns. So you're playing a completely different game. And you're watching CNBC and you're watching Jim Cramer, he's not playing the same game as you. He's playing what can I buy today that's going to be higher in 2 months, swing trade, and then sell it and buy something else. That's not long-term investing. And, I'm not bashing Jim. I read a couple of his books, and I think he did some really good stuff early on. But the show has become so much about, like, active trading, and it frustrates me a little bit. So just my 2 cents, my opinion. I bought Amazon at 3,200, now at 2,300. Yeah, I mean, if you really like Amazon, it's probably going to go a little lower. So at this point, I said 2,250 worst case scenario. I think worst case scenario now is maybe it's 2,000. I don't know. SQQ is the ticket. I mean, you can use SQQ to hedge, but it's not the ticket, because when the market turns, you're going to get your face torn off, so keep that in mind. Unacceptable, Jackson. Damn shots fired at Kathy. I'm not firing. What did I say about Kathy? Or did someone else say it? No, I'm not saying anything bad about Kathy at all. I'm just telling you facts. I own smartphones. I have ARKK. I've got ARKW. They're small percentages, and they're in my retirement, and they're in my retirement as speculative. If someone at $3,000 invest, which you recommend? I can't give financial advice, but if you just had $3,000, I'd probably just put it into S&P 500. Depends on your risk tolerance, like your age, your suitability. I generally say build up, S&P 500 core for your first core, and then build around it. Then you might get into more growth if you're younger, maybe QQQ. But most people will tell you this S&P 500, S&P 500 is, we've got historic returns that give you 10% a year. And if you're okay with that, then it's like the safest place, because the S&P 500 is the 500 largest companies in the US, and companies get kicked out and new companies get thrown in as companies perform better or worse. So it kind of, it's not actively managed. It's passive index fund, but it kind of manages itself, so to speak. Can Amazon recover with the upcoming stock split? Hard to say. I mean, it's going to probably require a catalyst like earnings as well, but it might have some short-term movement. But again, if you cut one pizza in 20 slices, it's still one pizza. What are your thoughts on ChargePoint Neo? I'm going to do these last couple questions, then I got to run. I don't know how long I've been on, but I think it's been a long time. Before I do that, guys, I will answer these last questions. If you have not subscribed, do that now. And there's a little bell for notifications. So when I start doing more of these live streams, you're going to get notifications, so you can jump on if you find this stuff interesting. Click the like on the video, and make sure to share it with a friend, and let's get the word out. I think there's a lot of good information on this stream, and it's been completely impromptu. I think I've been going on for 2 hours now. I don't even know. So I could talk about this stuff all day. All thoughts on team. I honestly used to use it and I didn't like it, so I don't own it. And I'm a big person. If I use something and don't like it, then I don't like to buy the stock. So I bought Costco in 2015 because I got a first Costco membership and it blew my mind. And I'm like, I got to own Costco. I just personally, I'm not from a stock perspective, an analyst perspective, it seems like a good company and it's probably a buy. It's the reason it's probably down. I don't know. Maybe there was an earnings miss, something, maybe growth slowing. Most of those stocks are just going to get sold off because valuations are high and the market's trying to revalue those at a lower multiple, so that's probably what it is. Do you think we're going to a short-term bull run? I think it's possible you could have, a relief rally. It might not stick, you know what I mean? Been good buying Google and Facebook. Google, I agree. Facebook, you could open up a can of worms there. I think that at this price level, it's hard to ignore it. One thing I'll say as a creator is I'm not a big fan of Instagram at all, but I know some people like it. And Reels, the one thing I'll say about Reels, both on Facebook and Instagram, both, is that 90% of the Reels you see are just TikToks regurgitated. And what's interesting about that, guys, I just started Snapchat last night. I have a video on TikTok. So I have a 1 minute short that I posted on TikTok, on YouTube, on Instagram, and on Facebook. And I tried to post that same short onto Snap, and they rejected it. And the only reason they rejected it is because it was a TikTok download and it had that little TikTok logo that jumps around. If you watch Reels on Facebook or Instagram, almost every one of those Reels is just a TikTok video that's reused. And it has the TikTok logo. So TikTok's getting like advertising on every one of those. And I don't know if I like that as an investor, And then I look at advertising spend too. The reason that Facebook's lower is that if we go into recession, then less small businesses are going to have money and they're going to have less money to spend on investing in advertising because the consumer spend is going to slow down. That's kind of the idea behind that. And then they're spending billions of dollars on metaverse, isn't going to pan out, blah, blah, blah. So anyway, but this video on TikTok, it got 225,000 views on TikTok. The same video on YouTube got 1,000 views, and the same video on Instagram got 400 views. Make of that what you will, but I think that's interesting. Same exact video, same tags, everything's exactly the same. So, I have SPY 40% portfolio. Should I sell some and buy VU? I can't tell you what to buy or sell, but I'll tell you the difference. So VU has a lower expense ratio. I believe it's 0.03. SPY is going to have a higher expense ratio. SPY has more liquidity. So generally, if you're a trader, you're going to trade SPY, SPY. If you're a long-term investor to buy and hold, you're usually going to use VU. It has a little bit less liquidity, less traders, and a lower expense ratio. It's almost like I had that scripted. I promise that question wasn't scripted. I have Facebook. You think it'll recover to 250? I don't know. I personally am not invested in Facebook, and I'm just not sure. So I'm probably wrong. It's probably a buy here, but as someone that uses it, it's my least favorite social media app to use. So I'd rather use Discord, TikTok, YouTube, even Snapchat seems better. So in Snapchat, I'll give them kudos. Like they're monitoring what you post on there, and if you've got a TikTok logo, they're not letting you do it. I think maybe Facebook and Reels should do something similar. But one last question. I would love Facebook go to zero. Brad says he's anti-Zuck. And that's part of it too. Sentiment can be really bad when people don't like, there's been a lot of political, stuff with that, and we won't go into all that, but there's going to be different sides of the fence, and that's going to decrease sentiment. That's going to impact the stock price and investor sentiment too. One last question. I'm in IT and work. Okay. All these odd confluent team now Snow, which I invest in, believe in, adding more here and holding. Anybody that works in IT that works with those products or that sells them, they're all going to tell you that they're expensive, but they're going to buy them anyway because they're going to be worth more money. At the end of the day, if you don't have that insight, then you might not have that same conviction. So you got to make sure you buy what you believe in and what you have conviction in. B2B, I think enterprise sales or enterprise SaaS, software as a service, these big companies cannot survive without it. And data, you think of Snowflake, You think of like Palantir, you think there's tons of companies that do all kinds of great things for businesses with data analytics, business intelligence. Data is so powerful. And if I'm a CIO, I'm going to cut headcount before I'm going to cut software. I'll probably just increase, more licenses and more software to help with efficiency. And those contracts are recurring revenue. They've got high margins, 70, 80% margins, the recurring revenue. And every contract, for the most part, I used to sell these SaaS contracts, they have inflation baked in. Now, inflation is not necessarily baked in at 7 or 8% like we're experiencing now, but it might be 3%. Well, they're at least recouping some of their costs. And on new deals they're selling, they still have some pricing power. They've got much more pricing power and they've got high margins, so they don't have the issues. And some of them are burning cash to grow, but you got to remember they're burning cash to grow because they're trying to grow. So if I've got $2 billion in cash and I'm burning $60 million a year, I'm not really that worried about it, but a lot of investors look at that and say, if I'm an institutional investor, I've got a playbook. My playbook says, does it have free cash? Does it have earnings? Does it have a PE ratio? Does it have a solid balance sheet? Does it have free cash flow? And you go down the line and you get to some like Confluent where it doesn't have free cash flow. It has, negative earnings. Margins aren't as high. It's not going to be in favor. It's going to get sold off. Anything that was a new IPO, fresh money, it's going to get sold off. So make sure you guys like, subscribe if you haven't. I'm going to wrap it up here. So thanks for sharing. Thank you guys. Did I miss anybody? So last call, any questions that are up there that I didn't hit, especially if you got anybody that tipped me today, I was not expecting that. Thank you very much for doing so. I at least covered all those guys, right? The ones for sure. I want to make sure if you at least had a question and tipped that I covered you guys. And I want to answer every question, whether you're tipped or not, but the ones that did, drop something, I appreciate that. I wasn't expecting it at all. So, yeah. What do you think about Palantir? I talked about Palantir earlier. I think it's fine. I'm running out of energy though, so I'm gonna have to save that one for another time because that could be a 30-minute rant if you get me started on it. So I still like Palantir. It wasn't a $30 stock. Let's put it that way. So, and I think that there's probably a little bit more hype on some of the channels that cover it. I'm a bull on it. So you guys know, this YouTube channel was the very first channel to cover Palantir, and it was a buy at direct listing at $9. It was never a pump when it was 25. It was never a video every other day saying $1 trillion market cap. And there's plenty of channels out there. I'm not even saying anybody specific, so I'm not even going to start that drama game. There's 20 different channels that did it, and that's fine. They do what they got to do for views. That's just not what I'm about. So, can I repeat everything I just said? Yes, I can. You know why? Because it's recorded, so you can go watch the recording. So perfect. Thank you guys. So yeah, I hope I didn't miss anybody. If I did, comment below and let me know if there's something I missed, and I'll answer. I'll write you back. So on the left-hand side down there, there's comments. Make sure you drop a comment. Every single person that's watching right now, I need you to drop a comment and say thank you, ask me a question. I want everybody to be talking in that channel because that's going to help the algorithm. And drop a like. Make sure you subscribe to the channel. I'm going to do these. I'm going to try to do these every Saturday morning unless my wife's got something tied up like birthday parties or something. So my plan is I'm going to try to do these on Saturdays. I'm going to do YouTube videos Tuesdays and Thursdays, do live streams on Saturdays. And we're just going to recap the market for as long as we need to. When the market gets boring again, maybe we won't do them anymore. But right now there's lots going on. I think it's good to stay in tune with you guys. I hope this helped a little bit. And if it did, check out the other stuff. Join our Patreon, our Discord. In the description of the video, there's links. You can join, basically I'm an affiliate of Motley Fool. So if you want to join their services, I can get a kickback. There's tons of things out there of information to help you guys. So at the end of the day, I'm here to provide as much information as I can, both free and some paid. And, the ones that want to support me, it helps me so I can do stuff like this. Because if I'm only making $400 a month in YouTube ads, I can't spend 2.5 hours and have my wife yell at me later. So, oh, look at this. I get to block somebody. Cool. Thank you for letting me block you. All right, cool. Tinder dating site. Yeah, awesome. Well, at least it only happened at the very end. So I'm going to cut it off there, guys. I appreciate your time and attention. Hope you have a great rest of your weekend. Hang in there, guys. Stay positive. Think about the future. But watch this video. Rewind it. Watch it again. Understand that there are risks too, okay? Thanks for your support. Have a great rest of your day. See ya.